New York City, I'm Shauna Smith alongside Jared Blickery, and this is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know this Thursday morning. We've got team coverage to start us off. Yahoo Finance's Josh Lipton and Madison Mills.
And let's start on the big story today. Stock futures clawing back losses as investors digest fresh economic data. The U.S. economy grew at a faster than expected pace in the second quarter. The latest GDP readings show that the economy grew at an annualized pace of 2.8% during the period, well above the 2% growth economists expected.
Taking a look at yields, pairing some of their earlier losses here at the report, marking a sharp acceleration in growth and could put into question the likelihood and timing of a rate cut this year.
And signs of weakness in the auto industry specifically here. We are looking at Ford and Stellantis. Ford shares stumbling after the automaker missed on second quarter profit due in part to quality. Warranty costs, which are used to pay for vehicle issues, rose by over $800 million from the previous quarter. Now, Ford did not lift its full year profit guidance like its big three rival GM. But I also want to flip the board over to Stellantis because it's a similar story over there. That stock down over 7% because of sales and earnings falling in the first half of this year. Particularly, the issue with them was free cash flow as well.
And airline stocks are taking a beating this morning. It's after underwhelming reports. American Airlines slashed its annual profit forecast and issued a weaker than expected outlook for its current quarter outlook as overcapacity issues weigh on most markets. Meanwhile, Southwest shares also in the red here after the airline saw its profit drop more than 46% in the second quarter. Southwest also warning non-fuel costs could potentially rise 13% as higher expenses and fare discounts are expected to weigh on the airline through the end of this year. Is coming at a time when the company is already under pressure from a hedge fund for disappointing financial results.
Kicking it off with our top story here this morning, GDP out just moments ago, and we're just about 28 minutes until the opening bell on the street. You can see futures pointing to a mixed open, but that reading that we're getting on GDP is really what is dominating the conversation here ahead of the bell. The U.S. economy growing at a much faster than expected rate in the second quarter. Core prices also rising at a faster rate as well. Yahoo Finance's markets reporter Josh Schaefer has a breakdown for us. And Josh, a bit of a surprise here this morning.
Yeah, surprising that GDP print. So you had the U.S. economy growing at an annualized pace of 2.8% in the second quarter. That's above estimates for 2%, higher than what we saw in the first quarter as well, which was below 2%. I think perhaps the big takeaway here, guys, being that it didn't come in lower than expected. I think that probably would have actually been maybe a little bit more of a market mover or something a little bit more concerning. Right now, what economists are sort of highlighting out of this release is what it means for the Fed and what it means for what we're going to hear from Jerome Powell next week. They think that this puts Powell in a good position to say that the economy is holding up for now and they can wait until September. I think there was a little bit of a growing conversation about would we see a surprise cut in July? Not a large camp, but there were some folks starting to suggest that. And it seems like this at least puts that at ease because the economy seems to be in pretty solid shape.
Yeah, and there was a lot of speculation. Well, the speculation now is that September will be the month, but even that raises the possibility of an election. It is an election year, so it raises the possibility of Fed independence being compromised. That's where it goes. But we also saw durable goods crash this morning. It came in at 6.6%, negative 6.6%. Survey was expecting 0.3%. So clearly the economic data is coming in mixed. We got some winners and we got some losers.
Right, and then you look at, say, the S&P Global manufacturing data yesterday that we got, right, those PMIs, and you see manufacturing coming in low, right, Jared, and contracting again, and we thought there might be a pickup there, but services come in hot. So it's definitely still an overall mixed story on the economy, which right now people think still points to some level of a soft landing, but kind of bringing it back to the market action that we've seen over the last day or two. I don't know if economic data is kind of the key driver right now, and we think about what's going to happen for the rest of the trading session. So I think it's going to be interesting to watch that.
What do you think this tells us when it comes to the spending numbers, the PCE print that we could get tomorrow? And we talk about that because the focus that the Fed obviously places on it in terms of the best reading on inflation. But do you think, because we were speaking before we came on the show here, just about what this means ultimately maybe for revisions that we could get tomorrow and where maybe we more realistically are in the Fed's fight to tame inflation?
Yeah, so economic estimates are really just a math equation at some point, right? And we're talking about second quarter PCE, and if economists had that at core PCE at 2.7% was the estimate this morning, it comes in at 2.9%. That means the numbers are a little bit off somewhere. It doesn't mean the numbers are necessarily off in that June PCE print tomorrow. Capital Economics was highlighting this morning that it could be revisions from prior months. Normally in the past couple months when we've seen revisions from prior months, say May's PCE or April's PCE, the markets cared a little bit less about that. But it could mean that the June PCE print that's coming in tomorrow is going to show core inflation increase more than people thought. That, of course, I do think would be a market-moving event. So we're just going to have to wait for that release tomorrow morning to see why, for the quarter, was it 2.9 instead of 2.7? Was it higher in June, which would be the fresh print, or was it higher in prior months? And we know at some point, if it was so far back, maybe the market won't react as much.
All right, great point there. All right, Josh, thanks so much. Well, futures and when you take a look at the equity market and the bond market reacting to that GDP print that we got out this morning, it was a positive surprise showing resilience and strength in the U.S. economy. Also, when you take a look at spending, that's also moved to the upside much higher than what the street had initially, or higher than the street had been forecasting. So here to make sense of what ultimately this means for the market, we want to bring in Megan Horniman, Verdant's Capital Advisors Chief Investment Officer. Megan, there's no shortage of topics to get into with you here this morning. Yesterday, we had the massive sell-off, a lot of that having to do or really driven by the larger cap tech names. Here we are this morning, and it seems like Wall Street almost reevaluating or taking a second look at as to what exactly this GDP print means for the Fed's plans to cut rates. I'm curious what you're most focused on here this morning ahead of the opening bell.
Well, I think what the data shows us today is that the Fed does not need to be in any rush. So I think anybody who expects a rate cut at the July meeting, I think that's completely off the table. And I think it even may put September in question. Let's keep in mind, though, that we still have a lot of data to get through before we get to that September meeting. But I think it gives the Fed that flexibility to say, hey, things are slowing, but they're still okay. The inflation component to this, we cannot forget this. It is coming down and it's rising at a slower pace, but it is still not where the Fed wants it to be. And our biggest concern is that the Fed is walking such a fine line here with inflation that if they come in and cut rates or insinuate that they're going to get on this kind of aggressive rate cutting cycle, that this can reignite inflation. That's one of the biggest risks that we see right now for the economy.
Question, though. We were talking about the inflation status right now. Let's talk about labor, because if we go up to the employment rate, if it takes up to 4.2%, I believe that will trigger the SOM rule, and then you can imagine the headlines that will come out of that. There is the recession indicator has just flashed this warning. Do you think that would give the Fed more cover to lower rates in September despite the election looming?
Yeah, I think the employment report's going to be really what decides if this is September or after September. I still think there is a likelihood you'll get a cut at some point in the fourth quarter. Just not exactly sure at this time which meeting it's going to be. I do think that the economy is slowing. To today's report, let's remember it is backward looking, but there are some signs of concern in the economy. The labor market, though, is not cracking as much as I think people are expecting. And so that, I think, is going to keep the Fed kind of on that defensive. So they may be able to cut once, but they may cut once and then say, hey, this is one time, we're taking it meeting by meeting. I think the labor market, we saw the jobless claims numbers today. They have been picking up, but they're still pretty low. So again, we'll wait and see what we get from the employment side of things. But I think right now, this is just kind of gives the Fed some time to just hold on. Let's get some more data, reassure people that they still want to cut rates, but there's just no rush for this.
Megan, let's talk about the sell-off that we've seen take place here on the street over the last several trading days. And we're coming off what was an ugly day here for markets yesterday. Are we starting to see the narrative shift surrounding AI? And I guess ultimately, maybe what does that tell us about the increase in volatility that we could see as a result?
We've been saying for some time that this AI momentum trade would probably end up stalling because eventually it'll hit a wall. We'll have to see earnings that are translated into this AI boom, and we're really not seeing that yet. And when you looked at from a valuation perspective, valuations had just priced in such perfection here from an earnings standpoint, from an interest rate standpoint, that eventually we would see some sort of a valuation correction. And I do think that's what we're in the beginning stages of seeing.
We got time for one more here. Anything else you want to leave with investors?
I think right now the best thing to do is take a look at your portfolios. We think volatility is going to accelerate through the rest of this year. It's going to present some opportunities for investors to get back into areas of the market that have been unloved. Small caps, we could talk about that. Small and mid caps have had a little bit of a rebound here lately, but from a relative attractiveness, they're very cheap compared to large cap. Make sure you're not significantly overweight in that large cap area that has run up so much. Rebalance your portfolio. Make sure you have some dry powder on the sidelines to put money to work, because we do think there's going to be opportunities in the fourth quarter.
To your point, small caps looking very strong on a technical basis, emerging from that multi-year base. Thank you, as always, Megan Horneman, Verdance Capital Advisors CIO. And Ford shares sinking after posting a big miss on profit in the second quarter. The automaker maintaining its earnings outlook for the full year, but raising its target for free cash flow. Yahoo Finance's Madison Mills has a breakdown for us. Maddie.
That's right, Jared. We know that dealers have been having to increase their incentives to get cars off of the lot, and that is playing through to some of these earnings prints from both Ford and Stellantis this morning. But I want to kick it off with Ford, because there are three critical things to watch for them. The number one is the profit miss coming in below expectations here, and part of that profit miss was issues with quality. We know that their warranty payments that they use to cover any costs related to vehicle issues went up by $800 million just over the last quarter, and the company did not disclose that total number last quarter or this quarter, so it could be much higher than that 800 million top line number here. I do want to flip the board over to our next thing that we're going to be looking at here, which is their full year earnings guidance. They did maintain that, but that is not what the street was looking for. They were looking for an update to their full year guidance. We know that GM has been able to increase their full year forward guidance for the second quarter in the row. So that was a big miss when it comes to Ford from an earnings perspective this morning. And then our last thing that we're going to look at here is, of course, EV pressures. We know that Ford Plus was the plan that Ford had in place to focus on EVs, but the Model E electric vehicle unit did lose over $1.14 billion just in the last quarter. So that was obviously disappointing as well. But I want to end on Stellantis, seeing some similar issues. The CEO talking this morning about how the domestic demand for EVs in the U.S. was actually overpriced, specifically by politicians, and that the demand for EVs has not met what politicians expected it to meet, both in the U.S. and then he also talked about some of the pressures that they are facing in competition with China, something that will certainly be critical to watch as we get closer to that November election day in terms of what politicians are thinking with policy that could impact EV sales moving forward, guys.
All right. Thank you for that, Maddie. And we're also watching shares of airlines move lower this morning. American Airlines and Southwest are just the latest in the industry to report second quarter earnings. Uneven travel demand, higher capacity levels, and airfare discounts are squeezing margins. For more on the results, let's bring in Mike Boyd, Boyd Group International President, and George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Analyst. Mike, let's begin with you and just your big picture overview of the results that we're getting in this morning.
Well, prepare for a bloodbath the rest of the year. What we're missing here, despite the doggerel put out by American Airlines, the fact of the matter is we have higher labor costs coming into play right now, and now we have a very desperate ULCC sector, which used to be somewhat separate. But we have carriers now like Frontier trying to barge into major markets, major O&D markets at American Airlines. That's going to happen. We have an excess of capacity at the ULCC sector. They're desperate. They're going to be putting more airplanes right into Americans' backyard, and United and Delta and Southwest. So I don't see anything really positive coming up for the rest of the year because this overcapacity is not going to go away.
George, what do you think? Do you agree?
Yeah, I think we saw, strong signs of overcapacity. If you look at American, what their yields were down in every market, important markets like domestic, down 6%. So, we kind of think of yields as synonymous with fares. Their two, big full service carrier competitors, United and Delta, did much better, down 1 or 2. So Americans in particularly bad shape. Southwest showed us down, I think it was 1 or 2% domestically. So they're showing the weakness too. We're starting to see capacity numbers come in for 3Q. I'm seeing 2 to 3% growth. That's better than I think the growth we saw in 2Q. But agreed, I think there's a lot of basic economy capacity out there. Everybody's trying to get more premium. And so I think it's going to be rough to turn 3Q around, and 4Q is always a weak quarter. So I think it's going to be a rough year for the airlines, rougher than they thought.
Mike, when it comes to what airlines need to do or can do in order to change the narrative and really shift some of the weakness or eliminate some of that weakness, a lot of that having to do with overcapacity. Walk us through just exactly what that looks like and how long it could potentially take. It sounds like until next year that an issue like this takes to correct.
Honestly, American, Delta, United, Southwest can't do anything about the overcapacity. The overcapacity is basically ULCCs, which are no longer ultra anything, trying to barge into markets where they can make money with their excess airplanes. And as a result of that, they're going to have to react. American, United, Delta, Southwest, they're going to have to react to these kinds of entries into the market. For example, Frontier going in a big way into Charlotte. American owns Charlotte, fee simple absolute. You can't stimulate new market going to Buffalo out of Charlotte. This is how desperate some of these ULCCs are. And American, Delta, United, Southwest, they're going to have to react to it because they're not running that show.
George, what do you make of Southwest kind of pivot here, getting rid of their free-for-all boarding process where now we can have assigned seats? Do you think that's in line with some of the discussion that we're just having, or is that just something that was inevitable?
I think it's totally in line with the discussion we're having. So I think this is part of how some of the larger carriers are going to try to fix things, right? So we know premium demand is better. I mean, frankly, when I fly, I don't fly basic economy, but I fly premium. And when I look at the premium economy seat, it reminds me a heck of a lot like what economy was prior to the pandemic and the re-rack by a lot of airlines that kind of went to this big, heavy density model like Spirit and Frontier. And so I think, this is Southwest, even Frontier are all looking for ways to pull in premium passengers, people willing to pay more for where they sit in the cabin or having a blocked middle seat. So to me, Southwest is sort of making the evolution to one of those big three carriers that has more premium offerings by slicing and dicing the cabin, charging people more to, sit together, to get preferential windows or aisle seats, and to have a premium product. And it's their way to try to stem this revenue slide and look better than the ULCCs.
Mike, let's talk about what's going on with Delta specifically, because it's still facing issues here from the CrowdStrike outage last Friday. They've canceled thousands of flights over the last several days. There's been estimates out there that they could actually take a profit hit of as much as $500 million due to some of this turmoil here. My question to you is, one, how big of an overhang do you see this being for the stock? And two, an issue like this, how big of a hit could Delta, or is Delta ultimately going to take here to its reputation?
Mike,
yeah.
Look, this is a real surprise because Delta, in terms of IT, they know what the average size of underwear are for their passengers. This is a real surprise that this breakdown happened. I think it was just simply a lucky hit that this Cloudflare or whatever they called it hit them. I think they're going to recover from that, but I think the good news is they're going to fix it. But they aren't like Southwest running around with backward systems. This is a real surprise because they're probably one of the most advanced out there in terms of tracking every single metric. So I'm confident that Mr. Bastian isn't going to let this happen again.
All right, Mike Boyd, always great to get your insight. Boyd Group International President, and of course our thanks to George Ferguson as well, Bloomberg Intelligence Senior Aerospace Defense and Airlines Analyst. Thanks, guys.
Thank you.
We're just getting started here on Morning Brief. IBM, a standout this morning. We're looking at gains of just about 2% thanks to strength in its AI business. We've got the details for you next. And Chipotle out with earnings after the bell yesterday. You're looking at the stock and now actually falling off just about 0.5%. When it comes to those results, they actually blew past expectations. Same store sales climbing over 11%, except it looks like the street isn't satisfied. We're going to be speaking with Chipotle CFO Jack Hartung later on this hour. We've got all that and more. You're watching Yahoo Finance. It's time for some trending tickers. First up, let's take a look at IBM. You're looking at gains in the pre-market trading of just over 1%. Now, this move comes after IBM reported bookings for its AI business rose above $2 billion since mid-2023. The company also seeing revenue rise nearly 2% from a year ago. Some of that was driven by a 7% jump in its software business. Software business was a standout here in the most recent quarter. Digging into where some more of that strength came into the Watson side of their business, I mentioned topping $2 billion. Now, this Gen AI platform launched last year. So when you take into account how much it has risen, how quickly it has really been able to generate some momentum within that business, obviously something that the street welcomes here. But again, overall revenue rise of 2%. Software revenue, again, though, increasing about 7% in the most recent quarter.
Yes, and I think the focus is on Gen AI. And interesting note by Morgan Stanley saying Gen AI consulting is cannibalistic to other consulting projects. So really just kind of taking over within organizations. Another comment by RBC, the Gen AI book of business grown to over $2 billion, to your point, since Watson X launched a year ago, ahead of expectations in our view. Price targets moving up, Morgan Stanley's to 182 from 179, over at RBC to a 211 from 200. And if we go to the Wi-Fi Interactive, just want to chart this real quickly. This is a 5-year look, and you can see we just broke to the upside relatively recently, but put a 20-year chart on, and this is just, this is a very long-term breakout from a long-term consolidation. It's a textbook chart you don't usually see play out on a time frame as long as this, but nevertheless, there you go. Nice breakout to the upside recently. And two big consumer brands we are watching moving in opposite directions. First, Unilever shares moving higher after seeing revenue rise over 2% in the first half of the year. Company also saying that the separation of its ice cream business is, quote, on track, or it's, quote, on track to complete by the end of 2025. And then over Nestle, moving lower after slashing its full year guidance. And you can see the shares down there 5%. Let me just quickly plot this on the Wi-Fi Interactive, and you can see Nestle. This is a staple, so these are two staple stocks. You don't expect them to move much, but it has been on the downslope over the last few years. Here's a 3-year look, and you can see down 16%. Here's a 10-year look, and then their 20-year, you can see still kind of respecting this trend line, kind of. I drew it in a little bit crooked there. And then Unilever, similar chart, although I could say it's been consolidating over the last 10 years or so.
Yeah, Jared, I think when it comes to right now, maybe the difference that we are seeing between Unilever and what we are seeing at Nestle is their strategy and their approach to pricing. And I bring this up because it's so critical as to where we are in the economic cycle right now. We know so many millions of Americans, and really around the world, the inflationary issues that consumers are dealing with. So Unilever, at least they did boost their volumes. Shares are up, like you just said, pretty substantially this year. A lot of that having to do with the shift that they did implement in terms of their pricing strategy. So when it comes to the fact that they were running at an average rate of 2.8% price increases towards the end of 2023. Now in the first half of 2024, they've scaled that back. It's now on an average of about 1.5%. As a result, they're seeing volumes increase as well, which is helping their business. Flipping that over and comparing that to what we saw from Nestle, a bit of a different story there. They actually had a drop in volumes, clearly weighing on the results this most recent quarter. They've hiked prices by 7.5% last year. So because of that, they are seeing some pushback from the consumer for their brands. I mean, I've even noticed when I've gone to the grocery store.
It's hard not to.
A lot of goods cost a heck of a lot more. And a lot of times, I mean, I do trade down to other items that are cheaper if you do see a substantial increase, because it's hard to justify, at least it's hard for me to justify, paying a heck of a lot more than I did just a year or two ago. So again, I think we're seeing that play out in these earnings results, and these two companies really showing how different approaches could lead to, obviously, extremely different outcomes, at least very much in the short term. Let's take a look at shares of Warner Brothers Discovery falling after the NBA rejected its matching offer to maintain the rights for games after next season. The league saying the offer, quote, did not match the terms of Amazon's proposal. As a result, we're seeing Warner Brothers Discovery off just about 5.5%. And Jared, our colleague.
That was a big loss here.
It was a big loss. Our colleague, Ali Canal, has been covering this very closely. And we're seeing the concern not only in real time in the share move to the downside, but also just in what analysts are saying out this morning, saying that losing these key rights now means that the company loses core content, not only for their linear networks, for Max streaming, not exactly something that Warner Brothers can afford right now.
No, but here's the flip side. Their expenses are way down.
That's true.
Here's also the same analyst, I believe, over at RBC. The long-term case for stocks looks more precarious, but it is arguably very cheap. It'll save a lot of money by not having to pay for the NBA, and the company may now accelerate possible breakup plans. Price target lowered to $9 from $13. And by the way, that was Macquarie, by the way. So I don't know if your end strategy, if you're an analyst saying that you're looking to possible breakup plans. I mean, I think that kind of speaks for itself.
Yeah, and I think that also goes to the fact as to what we've been talking about a lot here, just what is likely to play out within the media space, specifically with so many of these streamers, and especially when you take a look at the streaming giants. There has been lots of talk, I almost feel like it's been forever, that we've been talking about anticipated consolidation, what we're going to see. Yes, we did get the Paramount news just last week or a few weeks ago, but again, I think the question remains how quickly we are going to see consolidation. It sounds like it's inevitable, but you got to think there's something coming.
Yeah, we're talking media, and the M&A goes in a 10-year, 20-year cycle. Mm-hmm. We're somewhere right in here.
We are. Sure. And I think that that's also why you're seeing more bundling. So many of these companies are doing whatever they can in order to boost their streaming businesses, in order to boost the number of streamers that are coming to their platform. So again, some of those efforts have paid off, others not so much. That's why we've seen this bifurcation in terms of outperformance. And I think a lot of them are just trying to figure out how they are in any world going to compete with the leader of the pack, and that is Netflix. And once again, Netflix posting strong results again earlier this earnings season. So we'll hear from a number of these media companies here over the next several weeks, but this is going to be top of mind for so many analysts out there.
You know what's top of mind right now? I am fascinated to see the Mag 7 as they open up in a few seconds. You know, it's only yesterday that we had the biggest one-day loss ever, $760 billion in market cap just evaporated. So we got the bell coming in a few seconds here, and it's going to be interesting. Tech was down 4 or 5% yesterday, and I think it's also instructive that was the worst day of this bull market. And here's the bell on Wall Street.
We got the opening bell on Wall Street at the Nasdaq and the New York Stock Exchange. Like Jared was just noting, we have markets coming off what was a extremely rough weekday here for Wall Street yesterday. We saw those losses being led by this move lower in some of those larger cap tech names. We also saw the S&P fall victim as well. Here we are at the open. It looks like the S&P opening just a bit here to the upside as we wait for the Nasdaq to calibrate. We have seen I guess pairing some of those earlier losses that we did see earlier here ahead of the bell in terms of the futures markets. But again, you're looking at the S&P maybe reversing just a fraction of the losses that we saw yesterday, very early, but rough, just about 0.1%. But I think a lot of this focus is going to be on some of those names that you just mentioned when it comes to the Mag 7 names as we look ahead to the rest of tech earnings season and exactly maybe whether or not there is a bit more weakness ahead for that group.
Yeah, and this is a little bit of a bounce back that we're seeing right now. So this is kind of the reaction, the after the storm, if you want to call that. Let's go to the Wi-Fi Interactive real quickly, if we could. I just want to show you, this is a sector action. So mixed boards, staples are up 0.5%. We're talking Unilever, Nestle earnings. But then to the downside, materials is the biggest loser. But the real show is in the Nasdaq 100. And you can see more green than red. Nvidia is down 0.75%. But we can see the mega caps for the most part in the green. Tesla bouncing back, that's up 1%. But here's a two-day look, and this is just vastly different. There's Tesla down 11% now, Nvidia down 7%. You look at the sectors, a lot of damage done. Tech and consumer discretionary, that's where you have Tesla and Amazon. Both of those down 4.1% over the last 2 days, Shauna.
All right, Jared, we're going to take a quick break. But coming up next, we're going to take a look at the chip makers. We've seen a bit of conflicting headlines coming out from the chip space here over the last couple of days. We had NXP renewing some of those fears about what's ahead for the chip giants. Yesterday, though, we did see some of those fears, at least initially, being alleviated. Now we're looking at losses of about 1.5%. We're going to talk about whether or not now is a time to buy chips next.
Seeing a bit of a downturn for semiconductors in the last month or so, we've seen a rotation out of mega cap stocks and into the small caps, and tech earnings are prompting investors to question when big spending on generative AI is going to translate into revenue for these smaller companies. We're going to be getting results from Qualcomm, Intel next week, and here to weigh in is Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst. Thank you for joining us here. So what should we be thinking about after this nasty two-day sell-off that I'm seeing it continue today in semiconductors? Software bouncing back up, but the chip stocks just continuing that downward trend here. What do you make of this?
So chips have had such an incredible run over the past year that any hiccup, any rumor of something is setting the stocks going a lot lower, even those that are tied directly to AI infrastructure. And I think first of all, if you're even a midterm investor, you really need to contemplate what are going to be the downstream semiconductors that could get really hot aside from the Nvidias, the AMD, Intel, Marvell, and Broadcoms. Those are companies like Qualcomm, right? We haven't even seen the beginning of the pickup in the AI smartphone market. We haven't yet seen the big uptick yet in the AI PC market, but I believe that it is coming. And I would recommend that people look at a midterm and even, let's say, long-term approach of where those stocks are going or could go.
Patrick, what do you think is going to be the catalyst for that? All about AI. I guess what is really going to excite investors then about that next leg?
Well, I think what's going to excite them is that the profits and the revenue for those, I'll call them wave two companies, will see a pickup. And we might not see it directly in Qualcomm's next numbers, but the numbers after that print, I can see this accelerating because what every smartphone maker is doing is it's wrapping AI goodness around their smartphones, whether that's Apple, whether that's Samsung, and the 20 other major Android makers, and all that benefits Qualcomm. On the other hand, for Qualcomm, right, it appears that TSMC is raising prices of their leading edge foundries, and we haven't yet seen the impact of that. But when we see AMD, when we see Nvidia, when we see Qualcomm, we could get a view into that, and that could weigh on earnings.
You know, we just got the IBM earnings, and I was perusing the analyst commentary. Something stuck out to me. I'm going to ask you, I'm going to read it here, ask you your opinion. Gen AI consulting is cannibalistic to other consulting projects. And without weighing in on IBM or anything, do you think that the AI movement has become so big that it's just eating up at organizations other projects that may otherwise bear fruits?
The short answer is yes. And those companies that are serving the enterprise, if you look at the CIO agenda, the CEO agenda, even the board agenda, they want their IT groups to pivot to generative AI. And a lot of this, as I discuss, is about FOMO. It's the fear of missing out. And that's why you see companies that aren't engaged in the generative AI wave are seeing very mixed results because the budgets for those non-AI projects are being dialed down and replaced by AI internal budgets in the enterprise space.
All right, Patrick Moorhead, always great to get your insight. Thanks so much for taking the time to join us here this morning. More Insights and Strategy founder, CEO, and chief analyst. Thanks, Patrick. All right, we've got much more of your market action ahead. Again, taking a look at the major averages, not too far from the flat line. We did start the day mixed. We're going to take a look at what exactly this ultimately means for you, your portfolio. You've got the Dow up 53 points. We'll be right back. Chipotle shares reversing course today despite a beat on earnings, revenue, and same-store sales in its second quarter. Revenue jumping over 18%, same-store sales rising 11% from a year ago. Menu prices being 3% higher. Jack Hartung, he's Chipotle's CFO, joining us now alongside Yahoo Finance's executive editor, Brian Zazi. Jack, it's great to see you again. So let's talk about the movement that we're seeing in the stock, and I think more specifically maybe the reason why, because we did see the street get excited initially about the report, and then we saw a bit of a reversal here on that expected margin pressure. I guess, can you give us a better idea what that looks like and the cause here that we could potentially see that is weighing on margins?
Yeah, listen, first of all, we had a fantastic quarter. Our teams are doing a great job. We had a huge transaction, 8.7% in the first quarter, a comp of 11%. So really, really standout earnings. During the quarter, though, we did see sales step down, and that's consistent with what we've seen in kind of industry reports. We also talked about the fact that we've got a few things that are going to put some temporary pressure on our margins. A couple items are inflating from a cost standpoint. That's dairy and avocados. We think that is going to be, hit us for the next couple of quarters and then level off. There's also, we're moving from a chicken LTO, which chicken is our highest margin item. We're moving into brisket, which brisket's been a fan favorite. Our customer's been asking for brisket for a number of years since we had it as an LTO a few years ago. We're bringing that back. That is a very expensive item. And so from a margin standpoint, you move from a high margin to a low margin. It's still very, very profitable. Then last piece is we're going to proactively invest in making sure that every customer, every time, is getting abundant portions. We've seen the social media chatter. We were at one point thinking, okay, this is just going to run its course, but it just keeps coming back. So we're going to make sure every customer, when they come to Chipotle, they get abundant portions. And that's something that we think we can offset with efficiency. So all these margin pressures are going to be more transitory, temporary for the next couple of quarters.
Jack, you smoking that brisket in your backyard? I mean, that's a pretty hot new menu item there, sir.
I tell you what, we just tested it this week again in the test kitchen, and I'm happy to test it again if they need another opinion. It's fantastic, Brian. I kind of forgot how good it was the first time, so it's going to be, frankly, a big hit. We're very excited about it.
Let's drill into what you just mentioned about the portion sizes. This has really blown up on TikTok, and it just reinforces, I guess, the power of social media and how it can be used for wrong things. So when you said you're investing in abundant portions, how is that going to change my Chipotle experience? I can go in there and just say, just keep heaping spoons of stuff into a bowl. I mean, how does that change?
Well, so there's a couple different elements of it. The most important thing, we took this opportunity to look at how are we doing? And we're now focusing on kind of the bottom 10 or 15% of our restaurants. What I mean by that is we're looking for restaurants that have a disproportionate amount of customer comments on portion sizes. We're going back and retraining. We're spending more time with these restaurants. We have 3,500 restaurants. We think 90% of the time or more, the portions are abundant, but let's make sure that 90 turns into 100% of the time so that no customer leaves Chipotle disappointed because of portion size. It's one of our brand equities. The thing we don't want to do is take something that our customers love the idea that there's a lot of high quality food in their meal and then have it turn into a negative just because there's this social media, thing that we thought it would die down after a couple of weeks and it just keeps, coming back. We want to turn, that chatter into an asset where people are saying, oh my God, I went to Chipotle and I can't believe how big the portions are. That's our goal.
It's wild, Jack, when you started at Chipotle, I mean, there was no TikTok. I mean, so you don't have to deal with these challenges. You just worry about the financial statements and keep it moving. But one thing did catch my attention too, and it was California. Because really, that's the first time I heard, I think in a while maybe from Chipotle, that there was price resistance. Of course, wages went up in the States, so you took up your prices. For those, I guess, investors trapped in the Northeast bubble, how much is a burrito now in California? And now are you going to lower prices to get those customers back in the door?
Well, a burrito in California is still cheaper than it is in the Northeast. Now, it used to be about the same price as it would be in the middle of the country, which would be well below average. And now it's just a notch below. It's still less expensive than in cities like New York and Boston, but we did have to increase prices by 7%, between 6.5% to 7%, when we raised wages almost 20%. And what we've seen, Brian, it's not so much resistance. So it's not because the Chipotle burrito costs a little more. There's really a reduced spending across the restaurant industry. And when we've looked at it, restaurant companies that took a very high increase had a impact on sales about the same as what we've seen. Restaurants that have taken no increase had the same kind of reduction in sales. So it's really more of because everything's more expensive, the customer has pulled back in dining out, pretty much across the board.
Jack, when you talk about the fact that that's worrisome, even to companies like yours, that you're able to offset some of those headwinds just a bit. But I'm curious, when you try to figure out maybe how long some of these headwinds are going to stay with us, you're planning for the future, trying to navigate that. What are some of the strategies that you're implementing to better position Chipotle against some of those rivals?
Yeah, so our best offense is to have great operations. And that means hiring great people, training them so they know how to cook delicious food, serve delicious food, deliver great throughput. Our customers love the idea that they can come into Chipotle, and even if there is a line in Chipotle, they can customize their meal with our crew along the line and still get out of there very, very quickly. So it's high quality food, it's big portions, it's a fast experience, and it's the food that they crave. If we do that well, we feel like no matter what the environment, even if there is some economic challenges, no matter what the competition, that we will do well. And we've seen that really time and time again over the years.
Jack, you're about to wind down a decorated career at Chipotle. What's the biggest leadership lesson that you learned over your long time at Chipotle? So that's first. And secondarily, are you done in public company life? Is this it for you?
Well, okay, so the first one, there's lots of advice. I would say the most important thing is to, build a culture and build teams that match the culture. And what that means to me is hire people that are humble, but they're really confident at the same time. And now I know that sounds like those are two contradictory, but if you hire people that are very skilled, they're confident and they're skilled, but they're also humble, you could build a team around folks like that. And when a team like that buys into a purpose, like Chipotle is a purpose-driven company, you can accomplish great things. People would put the purpose, ahead of their own ambitions, which, by the way, when people come in and they're talented and they work hard and they work as a good teammate, their career will flourish as well. So to me, that's a way to build a great culture and build great teams. For me, Brian, I'm gonna, think about what I do next. I do want to help other companies. I don't know if that will be through advisory. I don't know if that will be through board activity. I'm not sure if I want to take on another, public company CFO role. I mean, I love this role. I can't imagine there's a better role in the country. But listen, I hope there's going to be a lot of, demand for to hear from some of my experiences. And I love helping people that are trying to run a business, especially small businesses that have big ambitions.
Hey, memo to the tens of millions of investors and fellow executives watching Yahoo Finance. Give Jack a call. He's got some time on his hands. Get him on your board. He knows what he's doing.
I love it.
Jack, thank you so much for taking the time. We wish you all the best and great words of advice. We look forward to hopefully having you back on Yahoo Finance
Thank you, guys.
soon. Jack Hartung, Chipotle's CFO, and of course our thanks to Brian Sozzi as well. Well, we're in the middle of earnings season. Once again, we're going to break down the reports that you need to be watching. We've got all that for you next.
All right, let's get to 3 other big earnings report we're watching. Hasbro, Universal Music Group, and Keurig Dr. Pepper. Hasbro share moving higher after beating profit expectations thanks to its digital gaming segment in the second quarter. And just looking at some of the commentary surrounding this, and we did have the opportunity to discuss some of this offline. This is really about Wizards, Dungeons and Dragons, Magic the Gathering. This is where their strongest suits lie. And here's a comment from Bloomberg Intelligence. Management's steady projection for a 4 to 6% adjusted operating margin for toys this year still looks challenging.
All right, well, challenging as well for our next name, and that's a Universal Music Group, moving to the downside after subscription and streaming revenue growth disappointed investors in their latest quarter, off the lows that we've seen here following this report. But again, a drop of just about 8%. When it comes to the street's reaction, you're seeing Citi, Barclays, and Guggenheim all neutralizing their ratings. Citi out, saying that this undermines what have been as defensive growth credentials here. Some of the issues within this report, looking at different in terms of those expectations, second quarter streaming and subscription constant currency growth meaningfully below the street's expectations, selling off as a result.
Yes, and got to hit Keurig Dr. Pepper in the green after soda prices increasing helped drive higher sales in its second quarter. And I do have some commentary by Bernstein. They rate an outperform with a price target of 39. Revenue and organic growth came in roughly in line with consensus expectations, which, quote, may come as something of a relief. And that's after disappointments came from PepsiCo and also home and personal care companies. So really not feeling the pressure that some of its rivals are. KDP.
All right, keep right here on Yahoo Finance. Coming up, should investors buy the recent drought that we've seen in tech stocks? We're going to dive into that and more on Catalyst.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
Taking a look at stocks, mixed here as we are a half hour after the open. The Nasdaq still under pressure after its worst day of the year. The Magnificent Seven names losing around $760 billion in market cap. Investors now look to next week with more earnings to come, bringing another test for the sector.
And yield pairing some of those earlier losses after the economy grew at a faster than anticipated pace in the second quarter. The next big data point out for investors is going to be the inflation print tomorrow, PCE. We know the Fed really focuses on that inflation print, so investors are going to be sifting through that number, trying to figure out exactly what that means for the Fed's path forward.
And moving on to Washington, Vice President Kamala Harris released her first campaign video of the 2024 presidential election cycle. This comes after President Biden gave a speech last night saying he is passing the torch to the next generation. We're going to keep tracking the latest with the election and how it could be impacting markets as we get closer to November.
The U.S. economy growing faster than expected, GDP increasing at a 2.8% annual pace with consumer spending, helping propel some of that growth. So what does this signal for the Fed's path forward for rate cuts? We want to talk about that and also what this ultimately means for the equity market. For that, we want to bring in Wei Li, BlackRock's global chief investment strategist. We also have Greg Dacko, EY chief economist. Great to see both of you. Greg, let me go to you because I think that this is more of an econ question, at least here at the top. We're trying to figure out how resilient the economy is up until this point. Ultimately, what this stronger than expected print means for the Fed's path forward. Does this ultimately take July off the table?
Well, I think July was largely off the table before this print. But what this report shows is an economy that was still robust in the second quarter. There was not a major slowdown in terms of economic activity. We still had consumers spending, although they were exercising a little bit more discretion in a high price, high interest rate environment. We still had businesses investing, especially in high growth areas and growth areas that also drive stronger productivity momentum. So those were the good signs in this GDP report. One thing that I will note is that we are seeing in the more recent data, as we pass the mid-year point, we are seeing some signs of a labor market cool down, not a retrenchment, but a slowdown, which is in turn feeding into slower real disposable income growth and will likely lead to even more caution when it comes to consumer spending. So the economy is gently cooling, but still retains that robust pace, which is quite encouraging from a broad perspective in terms of economic activity.
Wei, I want to bring you into the conversation because there are some signs of a soft landing depending on where you look within the data. Do you think that is going to be enough for markets to reverse course from the significant stumble that we saw over the past 24 hours here?
I think what really jumped out to me from the GDP print is the jump in the information processing equipment, high-tech equipment spend that boosted the GDP print. It really goes to show that AI spend is now boosting growth. Previously, it was more of a, yes, we think that's going to happen. This is showing that that is happening. We do think that there is more legs, more runway for the AI investment theme to play out. But obviously, in the context of thinner liquidity during summer, corporate buyback blackout, stronger yen that has been a popular, weaker yen had been a popular funding leg for global carry trades, and a stronger yen could unwind some of that. When you bring all the technical factors together, we're seeing a bit of a stumble, especially given how well this theme has done. But in a broader context, from a fundamental perspective, we think that there is more to go. And today's GDP print is a sign of that happening on a broader basis.
So wait, what does that mean for investors? Should they then be viewing this as a buying opportunity?
Well, I would caution against automatic buy the dip type of strategy. Obviously, we need to see where earnings are coming through. You know, you look at small cap, for example, that has been holding up better on a relative basis, but when we look at their earnings, 40% of Russell 2000 haven't actually delivered positive earnings looking back the 12 months. So we do need to see earnings coming through in this current earnings season. And to the extent the markets dislocate from fundamental convictions, we do want to lean in. Is market going to go up tomorrow? We don't know, but over a longer term horizon, we do think the fundamentals will prevail. And specifically when it comes to equities, we look at kind of tech, industrials, energy, healthcare. These are the sectors that are seeing earnings upgrades, and we expect them to carry a lot of the earnings season strength.
Well, Greg, I want to go to you on the thesis we can derive from the earnings we've been getting in so far. Taking a look at the weakness that we've seen, for example, in luxury, in autos, of course, in airlines. Is that a plot that the Federal Reserve needs to be paying attention to, or does something like the GDP number that we got in today pour cold water all over the potential weakness we're seeing in earnings?
Well, I think generally speaking, we have an environment where consumers are suggesting that prudence is better relative to exuberance, and they are being more discreet in their purchases, especially of high-priced items. But you have two consumers really out there. You have a consumer that is more highly debt burdened, one that is looking at weaker income growth, that is being more careful with their outlays. And then you have higher income, less debt burdened consumers that are still spending relatively freely. Overall, though, what is happening is that you're still seeing this disinflationary momentum. We continue to see disinflation working its way through the economy, and that should allow the Fed to start recalibrating monetary policy. As I've said on the show before, I think July and perhaps even June would have been a good time to start recalibrating monetary policy and do so gradually. There's no need to bring rates down to zero because the economy is still robust. But you are seeing an environment where there are some initial signs of a cool down in economic activity. It's gentle, but it's disinflationary, which is exactly what the Fed wants to do. And therefore, now is the optimal time to start recalibrating monetary policy. So I expect next week, Fed policymakers will likely open the door with September rate cut and potentially even a December rate cut after that.
All right, we're going to have to leave it there. Thank you both so much for joining us. That was Wei Li, BlackRock's Global Chief Investment Strategist. We also had Greg Dacco. He is over at EY as their Chief Economist. We are going to turn now to another big mover of the day. Looking at shares of AstraZeneca, that stock is down a little over 3.5% after reporting their second quarter results. Seeing strong demand for its cancer, rare disease, and heart disease drugs, but struggling in some other aspects of the earnings print. So joining me now to discuss, we've got Pascal Soriot, AstraZeneca's CEO, and I'm also joined by Yahoo Finance's senior health reporter Anjali Khemlani. Pascal, it's great to have you on. I want to jump in on what could potentially putting some downward pressure on this stock this morning, and that's specifically costs, which is a key issue for investors and the management of those costs. What is the single biggest change that you're going to make in the second half of this year to manage those costs a little bit more efficiently?
Well, thank you very much for having me today, and it's a great question. In fact, we had a great first half and a record second quarter where we almost achieved 13 billion sales. For the first half, we grew 18%. We actually upgraded our guidance both on the revenue and the profit side. We now expect mid-teens growth in revenue and profit, mid-teens being 15 to 17% growth. So we think this is very, very strong. The cost part is linked to the investment in R&D we're making. We continue investing strongly in our pipeline. We have a very strong lineup of new products. We're also investing in future technologies that will shape the future of medicine. We can talk about those. There's several of those that will shape the future of cancer care, but also cardiovascular medicine. And of course, investing in R&D creates additional costs in the near term. The second half of the year, the growth of our cost base would be less because last year we invested a lot in R&D in the second half. So I think people can expect moderated growth in the second half. But overall, we are very much on track. In fact, we are above what we expected at the beginning of the year and absolutely on track to deliver our long-term ambition.
Pascal, Angela here. Really good to see you again. I know that in part of the cancer and ongoing oncology growth, you're looking at those antibody drug conjugates, and that's part of the story of looking towards the future. But at the same time, you're also focusing on manufacturing, which we've seen as an area broadly across the sector that has been running into some issues. You've been looking at expanding as well in China. I know that's one of the growth areas for you. Can you talk to me about how you're doing that and what your thoughts are despite some of the pressure you're seeing from the U.S. government and the concerns that they have with that economy and with that country?
Yeah, it's a great question, actually, Angeli. But I think there's two questions in your question. One is the new technologies, and you're absolutely right. We're investing in new technologies, antibody-drug conjugates, new types of bispecific antibodies, radioconjugates. We're investing in cell therapy, and our vision for cancer is really to attack, if you will, the tumor in the case of a metastatic cancer, to attack the tumor with the combination of antibody-drug conjugates and new bispecific antibodies, break down the tumor, shrink it, bring it to a lower level of intensity, and then bring in cell therapy. And with this, we believe there is a possibility to bring cure to some cancers, some patients. It's very exciting, and it's going to take another few years to deliver, but very exciting. As a result, we're investing in manufacturing these antibody-drug conjugates, which is a combination of an antibody and a toxin. We're also investing in the manufacturing of radioconjugates and the manufacturing of cell therapy. We've invested in the building of a cell therapy manufacturing plant in Maryland. So all of this is driving a lot of investment, of course. As it relates to your second question, China and the US, essentially what we're doing is making sure that we have two supply chains, if you will. One taking care of the West, if you want to define like this, Western countries, and one that is more specifically targeted at supplying China and some emerging markets. So, we are really trying to have two supply chains that are relatively independent from each other.
Pascal, since you bring up China, I want to follow on that. Obviously, we are in the middle of a presidential election cycle here in the U.S. How are you thinking about the potential impact of either candidate taking office? Both have so far, and at least pulling from previous remarks from the Biden campaign at least, both have talked about increased tariffs that could impact U.S.-China tensions and potentially escalate the trade war moving forward. To what extent do you think that could be a headwind for AstraZeneca?
Yeah, I mean, first of all, thank you for the question, but I'm not a political commentator. So the only thing I can say is we operate in almost every country in the world. And as you can imagine, every country has a different political system and political environment. And essentially, we adapt to every environment we are in, and our focus is really delivering medicines to patients. Now, in terms of this China-US question, again, we are focusing on making sure we have two separate supply chains, and we separate the research and development part from the manufacturing part so that we can source innovation from one part of the world or the other. But when we have sourced this innovation, whether it's our own innovation or in-licensed innovation, we then develop it globally, and we insulate, if you want, the supply chain so we can supply various countries separately. The US is the number one source of innovation in the world in our industry. China is a second one, growing rapidly. And I think we need to continue sourcing innovation from China because it will benefit the entire world. And then, of course, make sure we can supply separately. And we also have 1.4 billion people in China who are getting richer and older and have diseases, of course, and then they need our medicines. They can afford our medicines. We need to take care of them. So we really try to stay true to our mission and manage the turbulences, if you want, through the mechanisms I've described.
Pascal, I hear your point on not being a political commentator, but I do also want to ask you, in light of the fact that we are in a pretty interesting year, if you will, politically in the U.S., and the type of pressure that the industry is facing. I know you've talked about your stance on the IRA in particular. One of your drugs is in the middle of negotiations. But moving forward, the outlook for the company, especially with the growth that you saw this quarter, what are you thinking about, and how are you thinking about the ways to continue that growth and meet your 2030 goals of $80 billion?
Yes, we have a very ambitious goal of 80 billion in 2030, $80 billion US dollars, that is, in 2030. And the US will continue to represent a very important part of this, both from an R&D and innovation viewpoint, a manufacturing viewpoint, and of course, a commercialization viewpoint. So, you know, political systems change, and of course, the pressure on access prices is there everywhere in the world, whether it's the US, Europe, and everywhere. But the United States has been and remain a very strong player in terms of innovation that benefits patients, but also benefits the economy, because a lot of that innovations create value in the United States that everybody benefits from. And we hope that future governments will keep this in mind, of course, and continue supporting investment in R&D and innovation that really changes people's lives, and I believe creates economic value. And within this, we will continue managing the pricing and access pressures we experience everywhere. One last point is, I think it's important for Americans to remember that the US is the country where people access innovation the fastest and the broadest, actually. And so American citizens have access to innovative medicines much earlier than everybody else in the world. It's not perfect. There are difficulties, there are challenges, but certainly healthcare in the US is ahead of what people get in Europe. There's no doubt about it.
All right, Pascal, we're going to have to leave it there, but really appreciate you joining us. That was Pascal Soriot, AstraZeneca's CEO, and of course, Yahoo Finance's senior health reporter, Anjali Khemlani. Anj, thanks for joining us as well.
Thank you very much.
Let's turn now to the latest in Washington. President Biden delivered a speech last night from the Oval Office explaining his decision to step aside and end his re-election campaign.
I believe my record as president, my leadership in the world, my vision for America's future, all merited a second term. But nothing can come in the way of saving our democracy. That includes personal ambition. So I've decided the best way forward is to pass the torch to a new generation.
Joining us now to react to that and also what lies ahead for the 2024 presidential race, we want to bring in Yahoo Finance's Washington correspondent, Ben Worshkull. Ben, it's great to have you here. So let's just start with what we heard from President Biden last night. What stuck out to you in his speech?
I mean, I think what stuck out was what you heard in that sound. This was a very somber, wistful sort of appearance. You know, a key subtext here was for Biden to be in front of cameras for the first time since he's been sick with COVID and kind of show the country he could continue for the next 6 months. And I think he did that. And there's some takeaways for the business community to the extent that there are any here. A big one is kind of what he signaled about how he wants to spend the next 6 months. There were some economic themes in there, and you saw some of it with more this morning in terms of his response to the GDP number. But overall, he's trying to focus on other issues. Israel's a big one. He's meeting with Bibi Netanyahu today. He talked about that a good amount in other parts of the speech. There's a few kind of smaller legislative ideas he has that he wants to push. But again, it sort of is more specific and sort of the overall idea of lowering the temperature and in terms of the markets, lowering the volatility. One takeaway I've heard in the last few hours about it is that this is his first farewell. So in other words, this is kind of his first farewell from the campaign, and then we'll have 6 more months, and then there'll be a farewell from his time as president.
That's really interesting context from your sources, Ben. Thanks for bringing us that. I do want to follow with you on the person that the president is passing the torch to, Vice President Kamala Harris, of course. She just released the first official video of her presidential campaign. It does feature Freedom by Beyonce, who gave her permission to feature that song. Ben, what are your sources telling you about the path forward for the Harris campaign, specifically as it relates to the all-critical factor for all campaigns, which is that fundraising piece?
For sure. Yeah, no, the contrast here in the last 12 hours, couldn't be more stark. You had that speech from Biden, and then you have this ad that features Beyonce. It's a remarkable difference. In terms of the mood among Democrats, the sense I get from talking to folks is there's a sense that this first 4 days of the Harris campaign couldn't have gone any better. She's consolidated the delegates. She's had a record-breaking donor haul. We can talk more about the donors. She's got no major opposition. And the Dems even signaled yesterday that they could begin the process of a virtual nomination. So she'd formally be the nominee, and that could begin as early as next week. All four of those things, Thursday afternoon when we got this letter from Biden, were definitely open questions, and now she's sort of seemed to have answered there. The donor side of it, as you mentioned, is a real big one. That's a big element of this too. A lot of donors immediately got behind her. Reid Hoffman was Biden's biggest donor as of a couple months ago. He was immediately on board. Other folks, George Soros' son was another one that got a lot of attention. Other folks I talked to. But real interesting one was another Reid. You're seeing it on the screen now. This is Reed Hastings of Netflix, the co-founder and executive chairman. So this is what he said after she secured the delegates. Congratulations to Kamala Harris. Now's the time to win. But what's telling is that 2 days before that, in that afternoon, he tweeted, Dem delegates need to pick a swing state winner. He doesn't mention her name, but that's sort of a telling little note of opposition in those early moments where maybe he's thinking about somebody like a Josh Shapiro, maybe he's thinking about Gretchen Whitmer. In that next day, all of those candidates got behind Kamala Harris, and now Reed Hastings is on board, and he's also reportedly donated $7 million to a Kamala Harris aligned group. So that sort of tells you how much it's consolidated. In terms of the overall picture, just to kind of level set for folks, Donald Trump is still the front runner here, I think is fair to say in terms of what we're looking for ahead to November. There was a CNN poll that had him 49% nationally, 46% for Harris. It's within the margin of error, and she's performing better than Biden did in the same poll. So that tells you that there's a certain amount of ground being made up, but at the same time, she's going up against a Trump campaign that just came off a pretty successful convention and has plenty of money that's of its own to put for the campaign ahead.
Ben, great insight. Thanks so much for bringing that to us. You never would have guessed that this was your first time on live. We were speaking to Elements. We were all very, very impressed back here in the studio. So, Ben, thank you so much for making the time to join us. We look forward to hopefully having you on Yahoo Finance Live even more. And also make sure to check out Ben's new podcast. It's Capital Gains. It airs every Friday on Yahoo Finance and on Spotify. It airs on Yahoo Finance, 12 p.m. Eastern Time. You certainly don't want to miss that. Well, coming up, we've got much more of your market action ahead. Stay tuned. You're watching Catalyst.
get to some trending tickers that we are watching. Shares of Viking Therapeutics jumping over 30% this morning after the company announced plans to advance its experimental weight loss injection into a later stage trial than previously anticipated. Yahoo Finance's Anjali Kemlani has the details for us. Anjali, a huge reaction in the stock.
Yeah, you just saw that on your screen. That is a huge jump, and that is because Viking is now, this little biotech is just gearing up to really compete with the two market contenders. That's Novo Nordisk and Eli Lilly, of course, with their two big injections on the market. Now, it's important to note that Viking is now entering the last stage of trials, and that is the most important to see if the thesis holds for its drug. If it does, it could be the third drug on the market, the third therapy on the market for obesity with its injection, and it is also advancing its oral therapy into phase 2. So that's going to be another one to watch not too far away. What's most interesting, the results, of course, matching sort of on par with what we've seen with Eli Lilly's Zepbound and Novo Nordisk's Wegovy, which is about a 15% weight loss. That's also what Viking reported, but we also know that it could be a contender for M&A, and that's something that has been sort of happening as a conversation under the radar for quite some time. We heard again from today from Jared Holz, Mizuho's healthcare sector expert, saying pretty much exactly that. He said in a note today that they believe that in time it could make sense for Viking to either sell entirely or at least partner with a large cap pharma player. And of course, we've seen the manufacturing and distribution struggles of the other contenders. So it will be interesting to see where Viking goes from here.
Certainly will be, and we're looking at that jump of just over 30% today. Anjali, let's talk about another name that's in your wheelhouse, and that's AbbVie. We got results out from that company here earlier today. It's a trending ticker on Yahoo Finance. We're looking at gains there, actually, of just about 5%.
Yeah, so AbbVie had a good quarter, and surprisingly so, considering all the sort of concern over its major drug, Humira. We know that that has been facing increasing competition in the market, and when the PBMs took it off of top tiers in the formulary, that has actually really hurt AbbVie's market share. It's now down to 80%, down from about 90 and above before, and it had been holding on to really the lion's share, but this quarter we've definitely seen the activity take hold. Meanwhile, it's being boosted by other drugs that are starting to take over and take the place of what Humira used to contribute to the revenue. That includes Skyrizi and Rinvoq, as well as Imbruvica. So those are three top drugs to look at when you're looking at this stock. Meanwhile, interesting little tidbit, Botox is another area that they did still have pretty good sales there, but lower than consensus. And I thought that was interesting because I don't know if you guys saw it, but New York City apparently is contributing to the rise of Botox used for sweat. People are getting injections to help save off the summer sweat. So I thought we were going to see like a boost in the revenues there, but we did not. So I'm surprised by that.
Sounds great, but it sounds really nice. That's a heck of a lot to spend to just not sweat a little bit.
Yeah.
But there's obviously the medical benefits when it talks about headaches, then you got sweating.
I mean, listen, I'll take it.
Yeah,
Multi-purpose, jack of all trades, Botox.
For the reasons everyone should go out and get Botox. All right, Anj, thanks so much. Let's take a look at shares of New York Community Bank, sinking after provisions for its loan losses coming in higher than expected. The company also announcing that Flagstar Bank has agreed to sell its residential mortgage servicing unit for about $1.4 billion. Now, this is a company that certainly has been front and center to the latest blip or weakness that we have seen play out within the regional banking space. Taking a look at today's drop, we had been looking at the biggest drop since March, so it's another quarterly loss here for the company. When you take a look at some of those reasons why there is some concern still with the positioning of the company, it's more than just one reason, but one of the reasons sticking out within this report is net interest margin contracting 30 basis points. Bad debt reserves, though, representing only 65% of non-performing loans. Now, I say only because that's versus 152% in Q1. Deposits were also up 6% this quarter. Some of that growth there being led by savings and also CDs. But again, Still, we are seeing this move lower here for New York Community Bancorp, off just about 8%. Lots of questions just about the health and stability of this name right now, Maddie.
Well, and it's interesting. I was just taking a look at the last earnings print that they had back in May. Shares were up over 30% after the CEO gave this plan for a 2-year path forward to profitability. So part of the reaction that we might be seeing today, and the degree of the reaction, is because of the expectations that were baked in by that path to profitability. But also, to your point, Shauna, the degree of the headwinds that we are seeing in things like non-accrual loans rising to 144%, a huge gain there. And also, they moved forward with this acquisition of Flagstar in an effort to become a little bit more of a commercial bank and get some revenue mix in the picture, because they were relying a lot on something like CRE, which has a lot of risks right now. And now management is under pressure, certainly from investors, to speed up that transition in an effort to sort of diversify the business as CRE does continue to struggle there.
Sorry.
No,
it's all
please.
you.
No,
I just about to jump in on you.
No. Well, this is an exciting interview that we're both going to get to participate in coming up next. ServiceNow shares are surging after the company boosted its full-year outlook, and we are speaking with the CEO of ServiceNow, CFO, on the other side of this break.
ServiceNow shares are moving higher. We're looking at a jump of just about 12% after the company beat on earnings and revenue for the second quarter. They also hiked their full year outlook, raising their guidance for subscription revenue and operating margin target. Joining us now to talk about more and some of the trends that we are seeing, we want to bring in Gina Mastantuono, ServiceNow's CFO. Gina, it's great to see you again. So talk to us about some of the trends that you are seeing within your business, because when you take a look at these results, and specifically your outlook, really pointing to some of that strong momentum. So what are you seeing from a demand perspective, and give us a better idea maybe of what the second half of the year is going to look like?
Thanks so much, Donna, for having me. So yes, really excited that we had tremendous beats across all of our top line growth and profitability metrics, which really show continued exceptional execution from our team. So super proud of that. We saw subscription revenue of 23%, CRPO, which is essentially our current backlog, at 22.5%, and then op margin at 27%. Really gives us confidence to raise that back half guide. And so we increased not only our subscription revenue guidance for the full year, but also our operating margin. And so what we're really seeing here is that ServiceNow's AI platform is really becoming that mission-critical part of our customers' operation, and it's really driving business transformation for our customers. And so, you know, we hear a lot, is Gen AI real? Well, we're certainly seeing it real in our business for our customers and for us. And so we're really excited about those trends. Now Assist, which is our Gen AI product growth engine, is basically the new product. It's the fastest growing new product in our company's history. And actually our new business in the quarter doubled quarter over quarter, with 11 deals greater than $1 million and 2 greater than 5. So we're putting up real numbers with real use cases for all of our customers.
Gina, what do you think that opportunity looks like down the road? And you talk about the tremendous growth, the demand that you're already seeing for your generative AI products there. Just give us a better sense of maybe what you see that potentially looking like a year, 2, 3 years from now.
Yeah, well, if you think about what our customers are seeing and the productivity gains, you know, one of our new customers, BT, Gen AI decreased the amount of time that their customer service agents are spending on certain tasks by 55%. Internally, we're customer zero for all of our products, and our Now Assist use cases, we've talked about the fact that we're finding over $10 million in annualized savings in just the first 6 months of use. And so if you just really think about what that opportunity means for all of our customers long term, I think the opportunity is quite large.
I want to talk to you about what you're hearing from customers, Gina, specifically within the AI space. What questions are you hearing from customers as they try to suss out the ROI for their own businesses on investing in your AI products?
Yeah, I think ROI is so important, right? They're willing to spend the money if they understand where they're going to get the ROI. And so really proving out those use cases with productivity and bottom line results are really where they're focused on. And why we're winning, it's really because we're infusing Gen AI into our one platform. It's a single pane of glass above all the legacy systems, and Gen AI is built into that platform, right? It's not a bolt-on. And so they're really looking to double down on these strategic platforms, and it's one of the reasons why we're differentiated and I think executing so well.
And this earnings cycle outside of ServiceNow, of course, other companies, I think of Alphabet, for example, getting dinged by Wall Street because of their capital expenditures related to AI. As the CFO of ServiceNow, when you hear about that punishment from the street for AI spend, does that start to get a little bit spooky for you?
Well, I think our approach to spending on this is a little bit different. So we are using very domain-specific large language models, which means that our CapEx requirements are not as great, right? And so they're smaller, easier to manage. The customer's data is all in one place. And so from that perspective, we're able to not only really drive these top-line beats, but at the same time raise our profitability guidance as well.
Gina, I'm curious from your perspective, just the narrative surrounding the street, and this really goes back to last quarter, and we saw software companies kind of take a hit as more of that focus was put on those that are providing the hardware, the chips, in terms of that next leg higher. From the conversations that you're having, do you think that narrative has shifted this time around? And what do you attribute it to? Is it more of those proven use cases?
Well, I think in all technology shifts, right, the hardware, the big hyperscalers are going to really see that that top line up front, but software is always going to catch up. And so I think the fact that we are really infusing that Gen AI into our platform and really driving use cases every single day, working with our customers, understanding what their issues and problems are and helping them solve them, all while driving better productivity and efficiency, is a game changer for them, and they're leaning in.
Gina, I'd be remiss to let you go without asking about CJ Desai quitting over that internal hiring policy violation. And this is particularly critical given all of the contracts that Service now has within the public sector. What changes is the company going to be making moving forward to avoid something like this happening again?
Well, first and foremost, our federal business is extremely important to us. And so clearly we took swift and decisive action right away, really to protect that business. You know, we are 24,000 employees strong with great execution, amazing innovation, and incredible bench strength at all levels. So we'll tighten our policies, make sure that nothing like this happens again. And at the end of the day, ServiceNow is helping governments during their most challenging times as a differentiator and really helping them solve problems. And so we're confident in our trajectory, and I don't feel that we'll miss a beat.
Gina, really appreciate you joining us. Thanks for taking the time after that earnings print to come on Yahoo Finance Live. That was Gina Mastantuono, ServiceNow's CFO. And we're going to have all of your markets action ahead, so stay tuned right here. You're watching Catalysts.
The U.S. economy growing faster than expected in the second quarter. So does this raise the chances of a soft landing? And what does this ultimately mean here for the markets, for the equity markets going forward? Here with the details to answer those questions, Yahoo Finance's markets reporter, Josh Schaefer. What do you think?
Yeah, Shauna, so it seems like the incoming data we've had this week, really over the last month, over the last couple months, has sort of added up to that soft landing base case, right? Obviously, the GDP print this morning showing the U.S. economy is largely holding up. You have inflation falling. People are talking about the Fed cutting soon. It seems like we might be able to hold on and get to when the Fed's cutting and inflation eventually reaching that goal without seeing a significant downturn in things like the labor market and potentially the economy as a whole. So we're getting soft landing right now, but it's not necessarily moving the market out of its direction. You take a look at the market today, you see the Nasdaq down, and mega caps are lagging. And so we're sort of trying to answer this question of why. And I think Morgan Stanley's Mike Wilson gave us a pretty solid answer to this when he spoke with Yahoo Finance's Brian Stasi on opening bids. I want to take a listen to that.
So even with that as your assumption, you should have the seasonal period for contraction is now. And so, yeah, the reality is that you also have a lot of things going on between the election between the earnings season, which we just mentioned, which is already starting to be kind of a sell the news event to some degree, which is normal at this time of the cycle.
So Wilson noting seasonality there, potential pickup in volatility, which we've certainly seen with the VIX over the last several days, significantly increasing. And one other thing, guys, that he highlighted, that BMO Capital Markets Brian Belsky also highlighted to you guys, is tech usually doesn't do that well in third quarter earnings. And to see this rotation out of tech maybe isn't surprising. So perhaps for this soft landing trade to really take place, you might not see it in the major indexes going up. But if you take a look at other areas of the market, those are still catching a bid. So it'll be interesting to see how long this rotation sort of travels and what it does to the major indexes. But we know from our Yahoo Finance chart book, pullbacks happen, and we haven't had the typical pullback we normally have. So that's sort of what strategists are talking about right now. This is normal, and we hadn't seen it yet.
And you got to check out the chart book, because it's going to answer those questions and more. It's on yahoofinance.com, led by our very own.
I gotta plug it. I gotta plug the chart book.
Plug it, of course.
32 charts. I mean, what more could you possibly ask for, right? It's 32. All right, Josh, thanks so much. As always, thanks for joining us. We're going to take a look now at the tech sector. Losses driving the Nasdaq to its worst day in 2024 on Wednesday's close. But we still got earnings to come from Amazon, Meta, Microsoft, and Apple. So what should investors be anticipating? Joining us now, we've got Paul Meeks, Harvest Portfolio Management Chief Investment Officer and Partner. Paul, thanks for joining us. So talk to me about this sell-off that we are seeing right now and how you're digesting it. Are you buying tech today, tomorrow?
I am not. I'm pretty comfortable with the continued AI infrastructure building names. And so I indeed plan to add to all of them that are on my favorites list. But what we've seen, and we're pretty early in the quarterly earnings season, is that it really doesn't matter what these companies say fundamentally. You could be spot on the fundamentals positively, and the stocks still get whacked. And so what I am doing is I have a prohibition on buying at least until we get through next week's reports. And then I'll assess. I imagine these stocks, no matter what they say, will be lower, and I probably will get back in.
Paul, what's on your favorites list? Can you share that?
Yeah, so on my favorites list, I continue to like the infrastructure plays more than I do on the companies such as software that will be developing products for AI customers coming out of the AI infrastructure building pipeline. So I like Nvidia, I like AMD, I like Dell, I like Hewlett-Packard Enterprises, and I like Supermicro. And we will get some good tells in the next week on all those names.
It sounds to me like you like the picks and shovels of AI. Is that an accurate kind of thesis here?
Yes, that's an accurate thesis. The way I look at it is you have AI infrastructure builders. That's part one of the game. And then you have what comes out on the other side, as such as the CFO of ServiceNow was talking about. I need to see more use cases, and maybe ServiceNow stocks up big today is going to be a good positive data point. I'm really rooting for them. Because before I move on to those part two AI trades, I need to see that ROI. I'm super comfortable that the arms race, the nuclear arms race, will continue, and it'll help my server and related semiconductor companies, even despite ServiceNow's good news today and AI use cases that they're talking about. I'm not there yet on those other tech stocks.
Paul, give us a better idea just on how long you think it could potentially be until we see more of those use cases, because I think that that's really at the crux of some of these questions that analysts and investors are trying to answer at this point.
Unfortunately, I don't think it comes anytime soon. That's another reason why I've avoided these companies that depend on, with their stock prices rising, on showing us some AI ROI. I don't even think it's really that much of an indication in 2025. Maybe this time next year, but right now it's based on a lot of conjecture. The use cases are very small sample sizes, and I'm jaded enough from doing this a long time that I'll believe it when I see it. But unfortunately, I think we're pretty far out on that. I hope ServiceNow and other companies come and prove me wrong. That would be awesome for everybody. But I need to see more evidence.
Well, Paul, we just had the ServiceNow CFO on after their earnings print in the market, certainly reacting positively. So we'll definitely have to bring you back, especially as we get those NVIDIA earnings coming in here in a couple of weeks, Paul. Thank you so much. That was Paul Meeks, Harvest Portfolio Management Chief Investment Officer and Partner. Coming up here, we're going to have all of your markets action ahead and a conversation about what's next for the Harris campaign. So stay tuned for more. You're watching Catalysts. More than 350 foreign policy and national security leaders, including former secretaries of state and defense, signed an open letter on Tuesday endorsing Vice President Harris in this November's presidential election. They argue that she would, quote, enter that office with more significant national security experience than the 4 presidents prior to President Biden. So for more, we want to welcome in Patrick Murphy, former U.S. Congressman and the 32nd Undersecretary of the Army, and also signer of that note. So we're going to get to that, and thank you so much for coming in. But I have to start on your recent time on the campaign trail with President Biden. You saw him up close, something that so many people across the country would love to have insight into. How did he seem to you?
Listen, he was back home. He was our 3rd senator when he was in the U.S. Senate because he's from Scranton, Pennsylvania. So he was upbeat. He was positive. Listen, the Air Force One was in the background, so it was a little loud, but he was ready. You know, he's ready to go. But then he obviously just got COVID recently, and he's still in recovery. But you know what he did last night on that speech about putting the country before himself. I mean, it's hard when you are the Democratic nominee, the sitting president, to say, "Hey, I'm going to take a step back, allow the next generation, a new generation of leaders, people like Kamala Harris and others, to really take the torch and move it forward."
What do you think, Congressman, Vice President Harris, in her campaign, or whoever ultimately becomes being the Democratic nominee, what kind of shift in tone do you think needs to happen in order to win over that independent vote? We've been talking to so many strategists, political strategists, over the last several weeks, and they talk about how important that independent vote is. What do they need to do to capture that?
No doubt. And I was an independent most of my life. When I was in the Army, you know, they kind of, when I joined at 19, they said, listen, we're unaffiliated, we're not political. So I was an independent until I ran for Congress and won. But I really think it's telling people not just why the other person shouldn't be hired, but why you should be hired, right? So when you have Kamala Harris, yes, she's talking about being a former prosecutor. She spent more years as a prosecutor, as an ADA, as a DA, as the Attorney General than she did in politics as a U.S. Senator or the Vice President. But there's a real contrast, and you have to let people know what the contrast is, and not just about, you know, obviously someone who believes in the rule of law versus someone who doesn't. but also how she's going to continue to keep our family safe here at home. I mean, the crime rate's gone down. The economy is moving. I mean, we just got the GDP numbers this morning, 2.8% growth. You know, people forget that there was 26 million Americans unemployed. And, you know, they have built the economy. They're moving things forward. Manufacturing's back. Jobs are back. Inflation is down. So, you know, we got to keep moving.
And you were able to win over that independent vote. So when it comes to the economy, specifically inflation, something that millions and our viewers still struggling with at this point, what is it that you think has not registered with the American voter right now? When you take a look at the polls, many Americans still blame President Biden right now for that higher inflation number. So what do you think needs to change?
Well, listen, I think the reality of it is people have been through the ringer. So I don't blame them. They should be angry, right? I mean, we just went through a global health pandemic and with COVID. We lost 1 million Americans. And inflation was at 9%. And part of that was, frankly, you know, too much government spending and the debt. But people need to realize that when Donald Trump was the president of the United States in those 4 years, the debt increased $8 trillion. Under President Biden, it increased $4 trillion. You know, I'm a blue dog Democrat. Like, I don't think we should be adding to our debt because I have 2 little kids. And when every American owes over $100,000 to national debt, and a debt that we have to pay interest on, by the way, it's like a bad credit card, we got to do better. And I think most serious folks in Washington understand that, and especially in the business community.
You were mentioning some of the policies under the Biden administration that have been successful, but that didn't show up in his polling, right? And that makes me wonder, was it really just about the mental acuity piece for voters? And of course, then that makes me wonder about some of the talking points that we're hearing from the Trump campaign about whether or not he has the mental acuity to stay in office through November. What do you say to voters who might be questioning that?
Well, I think most folks realize that, like, the really economic sentiment going into the presidential year is really established in the summer beforehand, right? So you look at the fact that gas prices were over $5. Now I got gas in Wildwood, New Jersey this morning. It was $3.42, right? So they look at inflation. It was at 9%. Now it's down to less than 3%, right? But no one's spiking a football. They understand they have to do more. But there's no doubt with a new voice, a new leader in Kamala Harris, that they could really move forward, you know, getting that message right. And this race is really going to be a contrast, not just about, you know, keeping families safe and keeping the economy moving forward, but people want to go back to the past versus people want to go to the future.
Do you think Harris needs Shapiro on the ticket to win since you're Pennsylvania guy?
Listen, I'm torn because I think we have an embarrassment of riches. I think you look at the top nominees for the Veep stakes, which are going to be decided in the next 2 weeks before August 7th. I think Josh Shapiro is phenomenal. I think that carries Pennsylvania if he's the vice president. I think Tim Walz, who was my roommate when I was in Congress, we were both Army guys. He was a command sergeant major, governor of Minnesota. I think, you know, he wrote the post-9/11 GI Bill, where there's like 1.1 million young Americans in college and universities under what Tim Walz did. And I think Secretary Pete Buttigieg, you know, with transportation, when you pass that bipartisan infrastructure bill that they used to talk about in the last administration, that they got it done, and now there's 56,000 projects of getting people back to work. I think we have those 3 are the top 3, I think, in the Veep stakes. They both bring new energy and both have a different perspective. And, you know, I think America will win if either one of those three is picked.
We will see how this all plays out. Congressman Patrick Murphy, it was great having you. Thanks so much for taking the time to join us here.
Thanks, guys.
We'll keep it right here on Yahoo Finance. Coming up, Wealth, dedicated to all of your personal finance needs. Very own Madison Mills, sitting right here to the left of me. Is going to have you here for the next hour, so stay tuned. I'll see you tomorrow.
Welcome to Wealth. I'm Madison Mills. I'm in for Brad Smith today, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to know to grow your money. On today's show, we're taking a look at the recent market rotation out of mega-cap tech. I'm going to speak with a portfolio manager about what you should be doing with your tech investments. And one U.S. airline is making a big change to its seating policy. We're going to break down that change and how it could impact your future travel. Plus, we're going to define the term loud budgeting. We're going to talk with an expert about how it could be a helpful money tool for you. But first, I'm going to do a quick check of the markets here, specifically looking at tech. The Nasdaq is trading just above the flat line here, recovering from its worst day of 2024 after a sell-off this week. Now, if you've been on the sidelines, it could be a question mark here. Is this the time to get into the tech trade? So joining me to discuss exactly that, we've got Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager. Burns, it's great to have you on. Thanks for being here. So listen, we had this pretty huge sell-off in tech, the worst of the year, at least when you look at the major indices. If I'm an investor listening to this wealth program right now, should I be using this as an opportunity to maybe go into my 401k, move some things around, get in on the Nasdaq when it's a little bit cheaper?
For some of the names, there definitely is going to be an opportunity to buy the dips. That said, this really could be the start of a longer and more enduring rotation. The two major factors that have really kicked this off, one of which has just simply been, we've had three below expected inflation prints in a row, which really cemented the idea that the Fed is probably going to have the opportunity to cut rates in September, which that tends to be a good thing as far as expanding breadth into some of the things that have lost over the last couple of years, things like value stocks, like small caps, some of the names like financials and areas. And then the other factor really over the past week has just been that earnings have come in, the expectations in a lot of these AI geared tech stocks have just gotten to be so high. You don't just have to beat earnings, you have to beat the whisper numbers. And that's something that could continue. It's really, what I'm describing is that the crux of the benefit of value investing. Value stocks are the types of names for which low expectations are built in versus a lot of these mega cap techs have extremely high expectations built in, and it's hard to meet them. I sort of say, if you have two students, an A+ student who comes home with an A-, or you have a C student that comes home with a B, which kid do you think is getting taken out for ice cream for beating expectations? I'd say it's probably the latter, and that's kind of what we're seeing in the market right now.
That's my favorite markets explanation I've ever had, Burns. So thank you for giving me that. I'm definitely going to steal that for future stories. But I do want to get a little bit more into the details of this for investors listening, because I get it. We've got to own quality. We got to be looking for that value play. But that's a little bit easier said than done. What is your rubric for sussing out value plays? And is it a scenario where individuals should be owning companies specifically, or a broader index that encapsulates several of those names? What do you think?
Well, for one, we always say, investors that don't have the time and the homework to really put a lot of time into really finding a good active manager, then buying some of the indices is certainly a low cost way of doing it. But that said, when you do have sharp market turns, there is some benefit to making sure you have someone at the wheel flying the plane and buying one of these active, value-oriented funds. As far as strategies to buy into that, we look for names that are producing a lot of free cash flow. One way to really kind of force yourself into that is buying companies that are paying and raising dividends, because obviously it requires a lot of cash to pay a dividend. But when a company makes the decision to raise their dividend, that really speaks more than anything to the management's confidence in the business. So that's one way to really get into some of the value names that we do expect the markets to rotate into. And of course, the markets, you have just really the benefit of reversion to the mean. Value stocks have lagged growth stocks in the U.S. for over a decade now. And, they usually trade a little bit of a discount, but that discount has gotten to be 1 or 2 standard deviations wider than usual. So, this may not be the major turn, but that said, we do believe it's a good time to maybe rotate into some of the more value-oriented areas of the market.
Burns, I'm going to end by asking you to do a little bit of a rapid fire stock pick game with me here. So I know that your favorite stock picks, you've got Honeywell, Rollins, and Crown Castle. Can you give me one sentence on each?
Sure. Rollins, basically are better known as Orkin. They're, they have a duopoly in the pest control space and a lot of recurring earnings. Crown Castle, it's a REIT that owns cell towers. And so that's just a way of playing the secular trends and rising demand for digital content. And Honeywell, as far as industrial conglomerates, they also benefit from long-term trends like automation or energy efficiency, and all of which can be done at a discount to their historical multiples.
All right, Burns, we're going to have to leave it there. Thank you so much for joining us and for giving us those picks. We appreciate it. That was Burns McKinney, NFJ Investment Group's Managing Director and SPM as well. Now, less Americans are filing for unemployment, at least over the course of the past week here, because initial jobless claims come in dropping more than expected and ticking lower than the prior week. Here to discuss what you need to know if you're in the job market here, we've got Nick Bunker, Indeed Hiring Lab Research Director. Nick, thanks so much for being here. So the unemployment data, at least today, didn't really move the needle that much, but what is the broader thesis that you think you could give our audience to sort of define where we're at with the labor market right now?
In short, the U.S. labor market's in a sweet spot right now. The issue moving forward is that it needs to stay in this groove that's in right now. We have seen the unemployment rate drift up, but it's still at 4.1%, quite low by historic levels. And job openings and Indeed's measure of job postings have drifted down over the last 2 years, but they're still well above pre-pandemic levels. And specifically to the UI claims data, we're still seeing rates of layoffs are still very low. So this is a labor market that's cooled down a lot over the past 2 years. In the spring of 2022, the ratio of job openings, unemployed workers, is close to 2. Now it's back to 1.2, which is, funny enough, what we saw back in 2019 as well. So it's a labor market that's rebalanced, it's moderated, and it's in a good spot right now. But any further increase in unemployment or reduction in job openings, that starts to, if not necessarily trip alarm bells, starts to make should start to make folks a little uncomfortable about how much this sweet spot we're in right now could last.
Well, talk to me about that piece specifically when it comes to individual sectors that could be at the most risk for our viewers listening in. What types of jobs are potentially about to suffer the most, frankly, from this potential downturn that we could see out of the sort of Goldilocks scenario that we're in right now with the labor market?
The tricky thing about that is that every recession is different. Or put another way, the way to understand which jobs are affected most by a downturn is to understand what actually caused the downturn. And we're not on the cusp of a recession by any means. I look at today's GDP report, but I think moving forward, there are a few culprits. The main one, if there were to be a recession sometime soon, would be high interest rates. So I think that means you want to take a look at what happens to employment in, say, construction. Or other interest rate sensitive sectors like manufacturing. And what we've seen from the data recently, particularly when it comes to construction, is that there's still healthy job gains there. It's not rip roaring by any means, but things are holding pretty steady. What has been interesting over the last 2 years is that the sectors that have really pulled back on hiring the most are a lot of traditional, what we used to call office jobs, but now they're more remote capable jobs. They've pulled back over the last postings on Indeed for those sectors are now actually below their pre-pandemic level. So we've seen a lot of pullback in hiring there, but it's not quite recessionary yet.
Talk to me about that from the perspective of job seekers, because at least anecdotally, the people I know who have unfortunately experienced layoffs over the past year or so, they're really struggling to find work. And this is a swift change from what we saw during the labor shortage following the pandemic. So talk to me about what that looks like and how long that could potentially last.
So we are seeing that hiring rates across the board are slowing down. Look at the government data. We've got hiring rates close to what we saw in, say, 2017, 2018, when the unemployment rate was low, but not the historic low levels that we saw early in 2022. I do think the speed at which you find a job right now, if you've been thrown out of work, does depend on the sector. If you are someone who has been laid off in, say, tech or media, it's going to take longer than it used to, and in some cases much longer than it used to. Where there are some other sectors where demand's still robust right now, and you're a period out of work might not be that long. If you look at the overall data, the median duration of unemployment from the Bureau of Labor Statistics, it's basically what we saw back in 2019, just before COVID hit. So there are certainly some pockets of the labor market right now where finding a job is taking longer than usual, but that's not, at least at this point, a broad-based economy-wide phenomenon.
All right, Nick, thanks so much for joining us. We appreciate it. That was Nick Bunker. He's Indeed the Hiring Labs Research Director. Moving on to another story that we are watching because one U.S. airline is making a big change to its business model. Southwest's open seating plan will become a thing of the past. The airline says it will start assigning seats and offering premium seating options on all flights. This includes about a third of seats that will have extended legroom. Southwest also announced it's adding 24-hour operation capabilities with the introduction of overnight red-eye flights. And this is interesting, right? Because open seating has been a key part of Southwest business for the last 50 years. People who love it really love it. But Southwest says that these changes are to adapt to customer preferences and to increase revenue. Now, on the customer front, the airline says when a customer chooses a competitor over Southwest, the open seating is cited as the #1 reason for the change. The company revenue remaining challenged. Southwest reported a 46% drop in the second quarter profits here. CEO Bob Jordan writing in a release that the company is taking, quote, urgent and deliberate steps to mitigate revenue challenges, saying the company is also under a lot of pressure to perform as it fends off a proxy fight with activist investor Elliott Management, which has a nearly $2 billion stake in the airline. Shares of Southwest down 50% over the last 5 years. And given what they said about open seating, it makes sense that they might be working to address their profit margins with that change. Now, coming up here, if you miss Chipotle's huge serving sizes, you're not alone, and you might be getting some good news here. We're going to have more details on those portion sizes right after the break. Chipotle beating expectations in their latest earnings print, reporting an over 8% increase in restaurant traffic in the second quarter. So what's the company doing to adapt to rising prices and deal with consumers pulling back overall? For more on this, we welcome in Peter Saleh, BTIG Managing Director and Restaurant Analyst. Peter, it's great to speak with you. I want to pull this line from your recent note, your investment thesis. You say that you view Chipotle as one of the best positioned restaurant concepts for the coming years due to sales growth, unit economics, long-term potential, and consumer trends. How do you anticipate that growth happening given that they are not going to be raising prices this year, according to this earnings print, and they did mention a couple of headwinds to come?
Yeah, so thanks for having me on. Look, you're getting an acceleration of unit growth from 8 to 10% over the next several years. That is going to be the foundation for their growth. You have this past quarter almost 9% traffic growth. I bet you when you see the rest of the industry, you're going to see negative traffic this quarter for the industry. So they're going to be 8 to 10% above the industry in terms of traffic. They're clearly taking share. They don't need to raise price to drive comp. They're doing it with traffic. So I think that's going to continue. We've got positive traffic in the third quarter. We expect it to continue into the fourth quarter. So I think they've got a lot of growth ahead of them. Yes, it's a little bit disappointing that margins are going to be a little bit weaker in the second half of the year and really third quarter and second half of the year. But I think some of that is based on the investments that they're making. So I still think the best-in-class operator with a lot of growth ahead of them, double-digit earnings growth. We think investors should really be taking a hard look at this with the stock down as much as it has been over the past couple of weeks.
And one of the things you also mentioned is that the portion size issue could weigh on margins. I just want to get your take on this because our reporter on this, Brooke DePalma, was just mentioning to me that the company kind of looked across all of its franchises and really looked at the portion sizing and didn't find too much of a problem. If they didn't find a problem, then why would that lead to some kind of change that would weigh on margins in the future? That makes it sound like they did have an issue that they're changing.
So I think they are trying to get ahead of this. I mean, social media seems to think they have a problem. The vast majority of their stores may not have a problem. So they're investing. Look, they're investing about 50 basis points, in of margin. This past quarter, in terms of restaurant level margin, they were almost at 29%. So I think they can afford to invest a modest amount of margin into some larger portions. I don't think it's the end of the world. It kind of quells the social media issues. So I think it's probably the right thing for them to do over the next several quarters until this issue kind of resolves itself and goes away.
All right, Peter, be honest with me. How are you as an analyst looking at those portion sizes? Are you going to Chipotle's across the country and doing a comparison? What are you looking at?
So I actually had it last night, and I only was able to eat half my bowl, put the other half in the fridge. So I think they are actually doing what they're saying they're doing. But also, in our view, I think if you order online, pick up in store, you're getting a slightly smaller bowl. I would advise that consumers to just go in and wait on the traditional line and get your bowl. For some reason, it feels like it's larger. So, honestly, I don't think this is much of an issue. Keep in mind, they have 3,500 stores and they switch out their server 2-3 times a day. So you've got 10,000 different servers every day. Everybody scoops a little bit different. So I don't know that this is really going to resolve this over the long term. Maybe some more training could help, but I really don't see this as a long-term issue.
Yeah, it's definitely interesting that you talk about the kind of tip for our users here that if you go in person, you get a little bit more bang for your buck. I do want to point out this soundbite we got earlier this morning. Chipotle CFO Jack Hartung joined our program and commented on this issue. Let's take a listen.
We're now focusing on kind of the bottom 10 or 15% of our restaurants. What I mean by that is we're looking for restaurants that have a disproportionate amount of customer comments on portion sizes. We're going back and retraining. We're spending more time with these restaurants. We have 3,500 restaurants. We think 90% of the time or more, the portions are abundant, but let's make sure that 90 turns into 100% of the time so that no customer leaves Chipotle disappointed because of portion size.
Peter, is there part of you as an analyst that feels like the portion size issue that the internet created is just noise for a company that is also dealing with its own inflationary pressures? The cost of food is going up for Chipotle as much as it is for consumers at the end of the day. Do you think that this is a distraction for executives?
It is noise, and it is a bit of a distraction. Clearly, social media has been coming after the restaurant space. We started with Starbucks in late last fall. It continued into the spring this year with McDonald's chasing them on much higher prices, which were also inaccurate. And then they transitioned to going after Chipotle for portion sizes. Look, I've been covering this company for 16 years, going on 17 years. We've had this issue in the past where investors were asking about portion sizes. But it wasn't as widespread on social media. Honestly, I don't see it as an issue personally. Again, I think if you order in store versus online, you're getting a larger portion. Maybe some of those consumers are ordering online. It is a distraction, but I think it's going to be short-lived in our view.
All right, Peter. So the message for investors, go in person, and also sounds like a good time to get in on the stock from your perspective, Peter. Thanks so much for being here. That was Peter Saleh, BTIG's managing director and restaurant analyst. We're going to stick with Chipotle here, diving deeper into what the burrito chain said about the impact of higher minimum wage, specifically in the state of California, as consumers seem to have pushed back to higher prices there. Let's bring in Yahoo Finance's Brooke DePalma, who I was just mentioning your great reporting on Chipotle. So thanks for joining us, Brooke. Talk to me about what's going on in California and this menu change that was impacting prices.
Bottom line, California customers in Chipotle and elsewhere are being resistant to the higher prices that these companies have taken. And what we heard there is this California FAST Act. Let's take a step back first and learn how that ultimately changed minimum wage. The California FAST Act went into effect April 1st. It then raised minimum wage from $16 to $20 for fast food chains that had more than 60 locations. That meant a 20% wage increase for Chipotle specifically. Now, in response to that, to offset these higher wages, Chipotle then had to raise prices for their menu in the state of California. That's caused Chipotle's menu prices in the state to increase by 6.5% to 7%. Now, many analysts thought that Chipotle would be immune to this, given the value perception, those big size burritos and bowls that you get, and also that loyal following that Chipotle tends to have. But it turns out that consumers ended up going less. And we asked CFO Jack Hartung about this earlier today, and here's what he had to say.
It's not so much resistance. So it's not because the Chipotle burrito costs a little more. There's really a reduced spending across the restaurant industry. And when we've looked at it, restaurant companies that took a very high increase had a impact on sales about the same as what we've seen. Restaurants that have taken no increase had the same kind of reduction in sales. So it's really more of because everything's more expensive, the customer has pulled back in dining out, pretty much across the board.
So consumers are really taking these higher prices and then not going out as much as they were before. Now, we did also ask Chipotle CFO Jack Hartung once again how exactly they plan to offset that impact. He said, Maddie, that Chipotle thinks that if it has great operations, it can give you a customizable quality meal, best bang for your buck here, and those fast experience that they really hone in on, getting through that line really fast, that they'll be able to win in this competition no matter, what economic challenges comes its way.
Well, it's interesting because it's not just Chipotle, as he was saying.
Yeah.
Talk to me about what your sources are telling you kind of across the industry here.
Yeah, this is a question that's prominent on Main Street and Wall Street's mind, really how the consumers responding to these higher prices. And what we've heard so far is, like Jack said, across the board, customers are pushing back. And we did ask Domino's Pizza CEO Russell Weiner earlier this week what he's seeing in the state. He said that they have not had to close locations so far. They haven't had to let go of drivers like their competitors. But he did say that with higher prices, you're going to get less orders in the near term when you tend to increase prices. But in addition to that, we're also hearing from franchisee owners within the state of California. We did hear from one specifically from McDonald's. He did share with Yahoo Finance that he had to close one location in the state. He's a decades long franchise owner. He chose to close one location just because of those higher costs that are coming to him.
I mean, that's interesting and going to be interesting interesting to monitor moving forward is the kind of cost-benefit analysis, and will others follow suit with that? So I know you'll be on that story for us,
Absolutely.
Brooke. Thank you so much for joining us. We really appreciate it. Our very own Brooke DePalma. Moving to another sector that is struggling here, luxury retail having a tough week. The French-based retailer Kering, it's the owner of Gucci, Bottega Veneta, and Balenciaga, among others, warning that profits will fall in the back half of the year off cooling demand. Revenue for the first half of the year fell 11%. In the second quarter, Gucci was the worst performing brand, with revenue falling 19% from last year on a comparable basis. Shares are moving lower for Kering today as well, down a little over 7%. And this comes after shares of LVMH also closed in the red after reporting a sales miss in the second quarter. Both Kering and LVMH referenced the economic and geopolitical uncertainty in their earnings reports as they looked for reasons to match the declines that they are seeing. But what does this mean for shoppers? Well, LVMH did cite shoppers traveling to Japan to take advantage of the favorable currency exchange. Sales in Japan actually up over 57% just in the last quarter. That, along with the top line data indicating that even luxury shoppers are starting to get pickier with their purchases, and that could certainly be something that the Federal Reserve and consumers look at moving forward as we start to see signs of weakness in the broader economy here. Now, coming up, it is the road ahead for EVs. From sleek sedans to rugged trucks, the competition is revving its engines. Find out who's leading the charge and which innovations are driving the future of transportation.
Here's why the Cybertruck is the perfect mom and family car. First of all, huge back trunk.
Here are 5 things that I hate about my Cybertruck. Number 1, there are fingerprints absolutely everywhere.
Tesla's Cybertruck is an EV tank with ultra-hard stainless steel metal meant to withstand just about anything. But the near $100,000 Cyberbeast is divisive. Under a year out from the truck's release, Tesla's issued 4 recalls for issues with the windshield wiper, truck bed trim, and accelerator pedal. Still, Tesla's producing 1,300 Cybertrucks a week, with the goal of reaching 2,500 weekly vehicles by the end of 2024. So, is the Cybertruck a win or a miss? Here's what investors should consider when evaluating Tesla's latest EV. Number 1, features. This is one source of appeal for consumers. For example, the Cybertruck is the first vehicle in the US to go fully steer-by-wire.
So most cars have a steering rack that connects the wheel to the actual drive-driven wheels, right? So the Cybertruck has actually motors and sensors that are not connected to one another. So basically you turn the steering wheel, the wheels turn. But what makes it special is that actually all 4 wheels can turn simultaneously based on just the input of the wheel.
Another factor, its durability. The Cybertruck's stainless steel skin is designed to prevent dents and long-term corrosion while also being bulletproof. Still, some features are a point of contention, especially when it comes to our next big focus. Number 2, the look.
When it came out in 2019, people their jaw dropped. They expected Elon Musk and Tesla to come out with a Rivian-looking pickup, right? Something a bit more normal, futuristic, but the Cybertruck is way out there, kind of hearkening to this sort of Blade Runner-esque dystopian future-looking kind of hard edges, stainless steel. I think that drew people off because it kind of reminded them of the DeLorean. That kind of design is sort of industrial, not necessarily consumer looking.
That look is part of what's impacting number 3, demand. While the Cybertruck is unlike any other car on the road, the hype has cooled down.
When the Cybertruck first came out, there was a lot of demand for those initial trucks. And we started seeing them pop up on auction sites with huge premiums. If you wanted it now, you got to pay up for it. Now, 6 months later, we're seeing a lot of these Cybertrucks hit auction sites and regular used car sites in mass quantity, and it's bringing down that price almost to the point that it's equalizing the price to pay that you pay to buy one straight from Tesla, which is not a good sign for any kind of vehicle from a demand point of view.
And that demand will play into our final focus. Number 4, costs. While Tesla hasn't revealed how much it really costs to build the Cybertruck, the vehicle was built at the company's new Texas Gigafactory, which Musk called a $10 billion investment. And the process to build it isn't easy. The unique exoskeleton is formed using a technique called air bending, where high air pressure is used to shape the stainless steel. Due to those production challenges, the cost of the most basic Cybertruck, coming in at $60,990, was more than what investors were hoping, which was closer to $50,000.
If you want to hit that $39,000, even $50,000 price tag. They're going to have to keep driving down their industrialization costs, meaning what it costs to make that vehicle. Can they make it cheaper as they scale up? They have more sort of expertise on building it. Can they get materials in there cheaper? Can they start simplifying systems? And I think the biggest issue with EVs these days in general is the fact they're too expensive. And can you make them cheaper for everyday people? That could help a lot to get that Cybertruck sales number higher.
Despite mixed reviews, loyal fans of Tesla may continue to support Musk's product visions. And the Cybertruck's unique polygon design might just be here to stay.
Is the Cybertruck design here to stay? I think if Musk had his way, yes. We've heard reports that when Walter Isaacson wrote the book on Musk, that he saw some initial sketches of the robotaxi and said it looked like a two-person Cybertruck. So that industrial design, hard edges, steel, might be a look that we'll see in future Tesla products, including that robotaxi and possibly cheaper EVs down the line.
We are in the midst of earnings season, and we are going to zoom in on automakers. Stellantis and Ford's disappointing earnings weighing on the broader sector here. You can see those stocks both down here. Stellantis down 7%, Ford down over 16%. They are leading a sell-off in the broader auto sector. So here to weigh in, we've got Greg Migliori, Autoblog Editor-in-Chief. Greg, thanks so much for being here. I want to start with you on Ford. I was fascinated by that $800 million statistic. That is citing specifically the warranty costs for the quarter increasing by $800 million. For consumers who might be watching this, might own a Ford, for example, what do they need to know about that? Is this a quality issue for Ford that is reminiscent of what we're seeing with the likes of Boeing, or is it something slightly less serious?
Hey, thanks for having me, guys. Specifically as it relates to Ford, they did have a disappointing quarter, and that was largely on the back of sort of older vehicles produced 2021 or before as far as warranty costs. These are vehicles that have to go back to the dealerships, perhaps for recalls, things like that, and the company, by extension, has to bear the brunt of those costs. So what Ford has said is that they're trying to focus on quality going forward so that their new portfolio, the vehicles that are the new vehicles on dealer lots, won't have this problem a few years down the road. Ford is well positioned as far as having some interesting EVs, and they've also been investing in their commercial business and their hybrid business in an effort to sort of diversify things. But as you can see, it was a pretty uneven quarter for them.
Yeah, let's go to the EVs that you mentioned there. The Model E electric vehicle unit losing over $1 billion just in this quarter. Why are they struggling so much on the EV side of things?
Well, right now, EVs are in a tough spot because it's very competitive. The margins can be pretty thin on them, and the technology is something that companies have to invest in to bring it to market. So for many companies, this is their first or second generation of electric vehicles, and they essentially need to pay off that technology. So right now, you're not going to fully realize that in the sticker prices of most vehicles. The federal tax incentive of $7,500, which is available for consumers, is meant to sort of ease that so car companies can charge a little more palatable prices. But right now, it's a little bit tough sledding in that sense.
Well, let's zero in on some car buying tips. If you are looking to buy an EV, should you be waiting for kind of the cheaper models that executives are getting pressured about on these earnings calls, or should you try to take advantage of current tax credits before the election? What's the right timing?
So I think now actually is a pretty good time as a consumer to be in the market for an EV. The selection has never been better. So whether it's Chevy, whether it's Volkswagen, Mercedes, Cadillac, Ford, Tesla, you name it. Basically, everybody has their take on electric vehicles. With the $7,500 tax credit that's available on some vehicles, and for people of certain incomes, they can still be pretty reasonably priced. You basically have to kind of make that decision. Hey, does the infrastructure work? Do you have chargers available either in your home or locally around you, perhaps on your drive route or where you might be working? So it's kind of a personal decision, but I think it is a good time to buy because, as the results of the presidential election could show, those $7,500 tax credits, funding for electric vehicle charging infrastructure, that could go away. Former President Trump has said that he's, basically not as interested in electric vehicles as President Biden is. So the landscape could change significantly. Right now, the selection's pretty good. There's a lot of EVs on dealer lots. You do have those tax incentives available.
Talk to me then about what you are hearing specifically from dealers who are on the ground selling these cars. How likely do you think they are to be willing to negotiate with customers to get these cars off the lot?
Well, I think dealers are always willing to negotiate. That's sort of the the secret power, if you will, of the consumer. Because right now you can arm yourself with all sorts of knowledge. You can figure out what the invoice price is. You can get all the available incentives and know what you should be paying going into the dealership. So it's different than it was even 15 years ago when you kind of had to sort of ask the dealer for the price, ask nicely, and then kind of negotiate from there. So I think consumers have a lot more power than they really ever have. And I think dealers, on their front, are willing to negotiate because so many people don't even want to set foot in a dealership that they're more than willing to have that conversation in an effort to try to move the metal.
All right, Greg, we're going to have to leave it there. Thanks so much for those tips for our audience. We appreciate it. That was Greg Migliore. He is Autoblog's editor-in-chief. Now, coming up here, budgeting. Everyone hopefully does it. I'm guilty of not doing it sometimes. But have you ever heard of loud budgeting? We're going to break down how that can be a powerful tool for your investments when we come back. One of the biggest finance trends on TikTok this year is, quote, loud budgeting. The trend is meant to encourage people to be honest and open about their finances. But how helpful is it, and how can you get involved if you're interested? Joining me now to discuss, we've got Brian Portnoy. He is the Shaping Wealth CEO. Brian, thanks for coming on to discuss this. So let's just start with what this is for those who aren't familiar. What exactly is loud budgeting?
Yeah, so loud budgeting, it's what's in the name. You're kind of living out loud with your finances. We typically don't talk much about money to others. This is the opposite. This is a kind of an interesting trend where you share with the world, or at least part of your social media network, what it is you're doing.
So if you take that into the real world and off social media, what advice do you have for folks who have grown up in a world where talking about money is very taboo? And sometimes, especially for those who are struggling with their finances, it can feel really vulnerable to talk about that openly.
Yeah, so it's a great point. And let's recognize that money is an emotional lightning rod. So all of the big emotions that we feel, fear, greed, joy, envy, regret, hope, they are absolutely tied to our money lives. So indulging in so-called loud budgeting, first and foremost, is an exercise in bravery. You know, the American Psychological Association looks at stress in America. Money's the #1 source of stress and the #1 topic that we don't want to really share with others. When we can indulge in this loud budgeting, and there's, I think, better and worse ways to do it, there's a whole host of benefits. It clarifies our thinking about what we want to spend, the goals that we want to achieve. It sets boundaries in a really interesting way. It is a commitment device. We're saying to the world, or at least to our online community, this is what I'm going to do. And in some sense, it's a way for you to be held accountable in front of others.
Talk to me about the best way to do it. You mentioned there are better and worse ways to do it. What is the best way for someone listening to this to start living it out?
Yeah, I think it's important to be just very crystal clear in terms of what you're trying to achieve. What we don't want to do is go online, whether it's TikTok or Twitter or some other platform, and just start, blasting out all of our financial details. That's not particularly healthy. What we might be wanting to do in the context of loud budgeting is saying, hey, I want to keep my spending under wraps. I want to have a disciplined plan, and here's how I'm going to do it. So be methodical, be step by step. We don't necessarily want to overshare, because that does become sort of an indulgent and emotional moment that's not particularly healthy for the audience, but especially for you. So I would say focus and small steps if you want to engage in this exercise, which actually can prove healthy.
All right, Brian, we're going to have to leave it there. Really appreciate you joining us on the concept of loud budgeting. Thank you so much.
You bet.
Now, moving on to President Biden addressing the nation on Wednesday, explaining his decision to step aside and, quote, pass the torch to the next generation. As the president gets ready to retire from his post at the Oval Office, it raises a broader question that millions of Americans face every year: how to handle any oncoming pressure to retire. Joining me now to discuss, we've got Yahoo Finance senior columnist Carrie Hannon. Carrie, thanks so much for being here with us. I think it's been interesting to see the president kind of undergo something that so many of fellow Americans face, certainly people in my family have faced. What does it tell us about any potential pressure that people face for retirement, and what advice would you have for those people who are confronting that pressure?
Yeah, exactly, Madison. Great to be here with you. This is a huge topic, and more Americans are turning 65 this year than ever in history. So this question is going to be coming up for a lot of people. And it really comes down, there's two pieces of it. There's the personal piece of this decision, and there's the financial piece. Now, the personal piece is pretty complicated, and it's no one size fits all for sure. And what it comes down to is self-awareness. It's really being able to look at yourself and be honest and say, what is my motivation for continuing to work? How is my health? What are my goals? sort of things of where am I today? Not where was I 5 years ago, 10 years ago, but where am I right now? And this is really hard for people because they have their identities really caught up in their jobs and who they are. So it's hard to disentangle yourself. And it's the sense of, what am I retiring to, not what I'm retiring from. And a lot of people can't make that jump to think what's ahead for them. And it gets, and the people who don't tap into this self-awareness, this real kind of, we call it getting up on the balcony and looking at yourself from a little bit of a distance. These are the people that tend to push back and be more resistant about retiring. So, I often recommend people, can you find someone that you trust to really talk about these issues, who will be clear with you about what they're seeing in terms of your health and your capabilities. This could be, a therapist, a retirement coach. It could be a good friend, a family member, but do reach out. And if you're at this grappling point, you don't have to make this decision all in a vacuum. Yes, it's your decision, but it really takes doing a little bit of this personal, really self-analysis and self-assessment about, being aware of who you are right now.
Well, Carrie, it's so interesting because there are those who want to stay at work and feel like they're being pushed out, but then there are others who would love to leave, but they feel like they don't have enough financially to support themselves to retire. What is your advice for those individuals who don't have enough money to retire right now, but would love to change that?
Yeah, absolutely, Madison. This is big for many, many people. It's daunting. If you were to retire at 65, potentially you could have 3 decades of life ahead of you, so a runway ahead of you. That are you prepared to pay for those costs of living? So what the best thing to do is, give yourself some space to really look at all of your expenses. What it doesn't have to be down to the exact number, but what are some of the non-negotiable expenses you're going to have moving forward, and what are the ones that are going to be more flexible? Once you get a beat on this sort of thing, you might figure out ways to get lean and mean. Now, secondly, you might just have to buckle down and grit it out. How much longer can you keep working and keep stocking away as much money as possible? I mean, most financial planners say if you can set aside 15% of your income, your contribution combined with an employer contribution that matches yours, if you have that, if you're lucky enough to have that, is good. But in this instance, if you're nearing retirement, hey, go for that 25% if you can. Sock away. Secondly, the third thing, can you push back on Social Security? Don't take it at 62. Try not to take it at your full retirement age if you can. Not everyone can do this, I understand, for many reasons. But if you can push back to age 70, you're going to get the biggest bang for your check moving forward for the rest of your life. And if you think you need to continue, the other big piece, Madison, I'm sorry, is look at your whole wealth picture. Some people get caught up in just that retirement savings account. You might be better off than you think you are, because if you take into your home equity, some other savings, other outside things that you have going for you, you might not be in such bad shape as you think you are if you're just focusing on a retirement account.
Carrie, you always make me feel safer. Thank you so much for joining us. And I know you make our audience feel that way as well. Thank you so much.
Thanks, Madison.
Well, moving on, we're gonna answer another huge question folks have on their minds during the summer heat. Is it time to stock up on Christmas gifts? You might want to toy around with that idea. We are taking a look at how toy makers are faring and what that could mean for your wallet next. Shares of the toy maker Hasbro are trading higher today after the company beat on revenue and profit expectations in the second quarter, also boosting full-year adjusted EBITDA expectations. Part of that beat was a strong performance from digital gaming, including from Monopoly Go. So here to dig into those results in the toy industry at large, we're going to be joined by James Zahn. He is the editor-in-chief of the Toy Book and senior editor of the Toy Insider. James, it's so great to have you. Love the background. Thanks for joining us. I want to start on the trends that you're seeing show up in an earnings print like this. We've got things like Magic the Gathering getting a huge shout out, obviously Monopoly Go. Are these trends that you're seeing in your day-to-day as well in terms of what people and consumers are interested in?
Hey, first of all, thanks for having me again. And yes, these are trends that are popping up. Monopoly Go, for example, that game is so big digitally that Hasbro spun it backwards, and there's a Monopoly Go board game now. So you went board game to digital, back to board game with a new play pattern. So there's a lot happening. Hasbro, of course, is refocusing on its core business of being a great toy and game maker. And the games, of course, are fueling a lot of growth because a lot of the players are older.
What does it tell you about the broader zeitgeist right now that you've got a game like Monopoly Go performing so well?
I think it's something that's cross-generational because we've changed society-wise. So people, of course, are playing with the phones in their pockets. They want something that they can play on the go. But at the same time, everybody loves that tactile experience of getting together with friends and family, playing something on the tabletop. And that's why Monopoly has been such a huge hit over the decades. And we've seen that with some of their other titles as well. It's actually a big anniversary year for a bunch of the Hasbro games like Connect 4 and Clue and Candyland. And those games, they just keep going and going.
Well, it brings up this other point that I want to get to with you, which is adult demand for toys. Talk to me about what that looks like and how these companies are setting themselves up to capitalize off that adult demand.
Sure. So over the past couple of years, we've seen this huge growth in the adult consumer, the adult collector or enthusiast. Some folks are calling them kidults. Well, the adult audience has always been there for toys. Since the beginning of time, if it can be collected, someone will be collecting it. But we really hit this point during the pandemic where folks were reconnecting with the stuff that they were into as kids. So now we have an industry where about 25% of all of the toys and games sold are for an adult audience. On Hasbro's earning call this morning, Chris Cox, the CEO, mentioned that about 60% of Hasbro's revenue is coming from consumers that are ages 13 and up. So what we've seen is a swing of older kids and grown-ups and teens and tweens. They're reconnecting with play and in new ways. So you've got these experiences, you've got the games, and you've got the premium price. Mattel, conversely, they're also getting into this. Both of these big titans are going direct to consumers. So you've got Mattel Creations as a platform, Hasbro Pulse, and then when you look beyond that, even Funko, Lego, Jazzwares, they're all creating their own platforms to meet the customer demand for those adult items.
Really quickly here, James, when is the best time to be buying toys if you are smart enough and organized enough to be thinking ahead of the holiday season this year? When should people be buying those gifts?
I always say late September, early October, great time because all of the hot lists are going to be out. You're going to know what to get before it's sold out. At the same time, if you're looking for discounts, now is a great time to be hitting up those closeout channels like Ross and Ollie's and stuff and looking for maybe some of last year's stuff that you can get at a really deep discount.
All right, James, always appreciate it. Thank you for making time for Yahoo Finance.
That
was James Zahn. He is the editor-in-chief of the Toy Book and senior editor of the Toy Insider. Well, guys, that is it for Wealth. I am Madison Mills. Thanks so much for joining me as I filled in this hour today. And stay tuned for more. We've got Market Domination with Julie Hyman and Josh Lipton. That's coming up for you right here at 3 p.m. Eastern. You won't want to miss it.